Okay, good morning, everyone. Welcome to the Global Macro Conference that we have been hosting with UBS since 2010, in fact. So it's always a pleasure to bring people again together. Thank you for your participations. Thank you also to all our speakers who have accepted to join the conference today. We will start with the usual global macro sessions with a mix of central banks, academics. As we have said before, this is live stream, open to media. Aren Captain, the Global Chief Economist of UBS, will be sharing the first session. Thanks again for joining, and Aren, over to you.
Right. Just the logo. I'm not sure. Is this working? Ah, fantastic. Okay, there's no light or anything. Thanks very much, Mark. We're not going to do long introductions, but I'm honored to have with me on this panel Martin Kazaks, Governor of Central Bank of Latvia. Hi, Martin. Jason Furman, Professor of Economics at Harvard. Axel Weber, currently President of the Center of Financial Studies, but also my former boss. And Catherine Mann, member of the MPC at the Bank of England. So the format is as follows. We're going to get every speaker to sort of just set the stage, give a few opening remarks relatively briefly. Then we'll jump straight into Q&A. I'll sort of lead us off with a bunch of questions, and we'll allow plenty of time for audience questions. So we'll get to that more towards the end. I've sort of agreed with the speakers that the order of the opening remarks is that Catherine goes first. Then Martins, then Jason, and then Axel. You were stuck in traffic, so you go last. Good. So, okay, great. Catherine, over to you.
Thanks very much for the invitation from Mark and the Bretton Woods group. I think I'm the person starting us off because I'm the country that's between the large players, and you're part of the large players. So I'm the small open economy that sits in the middle. And that's going to be an important feature of some of my remarks that we get to start with. So I am going to talk about the UK economy, give a little bit of an overview of the state of the activity and prices, and then leave other sort of questions for later, comments for later. So we've been happily upgraded. This has been a good week for the UK, with upgrades from the IMF, from the OECD, Consensus Economics. So, good week in terms of prospects for the UK economy on the activity side. I think it's fair to say, however, that even with the upgrade, prospects are still pretty modest, at least in comparison to one of my neighbors, although it is perhaps better than the other of my neighbor. So still, it's a little bit north of 1%, but not far north. When we think about prospects for activity going forward, or when I think about it, consumer behavior really is the linchpin. It has been the case over time that, how the consumer goes is really how business investment goes. It's how the state of the fiscal side goes, and so forth. When I look at consumer behavior in the UK, I focus on income deciles. I think that looking at disaggregated behavior is particularly important in trying to understand dynamics of the current environment, but also dynamics prospects for the future. Now, this middle income group is a particularly important one. First, they have been exposed to a relatively greater degree to tax bracket creep. As you know, tax brackets were fixed with underinflation. More of this group had their income creep into a higher income tax bracket, and that's an important consideration for purchasing power in the current environment, but also going forward. This group is also the one that tends to have higher outstanding mortgage exposure. There are other groups who have fully owned outright home ownership. They're in a different category. This group is more exposed to mortgages. And I would argue that this group also is the one that has been more scarred over the last 2 years with high volatility in the cost of their consumer basket. And an important question going forward is whether or not this volatility in the cost of their consumer basket has led to an environment of scarring and a desire to have a higher savings buffer than in past times. This is particularly important because in the past, I have said that the higher savings rate that we did observe, and it still is pretty high. But in the past, I have said that's dry powder for consumption going forward. I think it bears some consideration and research to determine whether or not this scarring is particularly evident for this middle income group. So we got work going on that. Now, the other factor that is particularly important that we identified in the last forecast round, we are headed into another one right now, but in the last forecast round in August, the Monetary Policy Report identified the then announced fiscal policy by the previous administration as being a significant drag on economic activity, an opening up of the output gap, a rising unemployment rate, and therefore a deceleration in inflation. I obviously am going to make no remarks about the upcoming budget. I don't know anything more than you do, reading the newspapers, but I will note that the previous forecast did have fiscal drag as being an important ingredient in the slowdown in the economy that was associated also in that forecast. Now on prices, the situation is, again, we can say it's good news. Our headline price print that was a week or so ago, 1.7. That was lower than projected in the August Monetary Policy Report. Services, which of course we have looked at very carefully for persistence, came in under 5 for the first time in a very, very long time. Now, a little bit of a concern, goods prices a little bit higher. In order to get to a target consistent 2% inflation rate, services still have a long way to go. They need to get to about 3. And a question is, is the improvement in the price picture for services something that is just this time or something that we will see continuing going forward? One way we can look at that is we can look at the forward-looking expectations coming from the decision maker panel. That's our panel of firms. And we do identify that firms have said it's harder to pass through price increases, that there is more pricing pressure. On the other hand, they do expect to have wages coming in at 4% or so for next year, and similarly for services. So there is this sense in which the deceleration that we're seeing might, in the DMP panel, 1 year looking forward, looking at a flattening, not quite getting us to the 2% in the medium term. In addition, our off-gem price cap, which is the household energy pricing pattern, they've already announced a 10% increase for the average household. Now, for me, the things that I look at most carefully in order to identify prospects for inflation coming down, especially in services, to come down to this approximately 3%, which would be consistent with historical behavior, as I'm looking at the most income and price elastic categories of services. This is entertainment, this is packaged holidays, this is restaurants. These are the things that really are discretionary, and they are particularly discretionary for the middle income group, which takes me back to why I look at why I spend so much time looking at income deciles. My last comment will be about my neighbors, and that is, there are many periods of time over the last year when the behavior of my curve, particularly at the longer end, 10-year yield, has moved much more because of macroeconomic events and associated policy movements or policy expectations. Those movements have been far more important than what I have done or my economy. So the spillovers from particularly that neighbor and a little bit from this neighbor, the spillovers in terms of both economic activity and prospects for monetary policy stance become a dominant driver of my yield curve. And that creates a very interesting environment for me as a central banker. And I will leave my comments at that
Fantastic. Thank you, Catherine. Martin, so over to you.
Thank you, and thanks a lot for having me. Just a couple of things to kick off with. One, on inflation, of course, we are seeing that this inflation is continuing. We see that inflation has been, in fact, in the last couple of months, undershooting the forecast. Our forecast going forward over the next few months shows that inflation will rebound, but of course, it's very interesting to it will be interesting to see what will happen with the reading. In fact, maybe it will undershoot it. So the storyline could be that in December, when we look at the updated forecast, to see when do we return to 2%, is that the end of the next year, or is that somewhat earlier? And economic weakness, what we see currently, of course, points to the situation that we are quite likely to see that 2% might be reached earlier than the end of the next year. As for the rates themselves, of course, the storyline of trajectory for the rates down is still there. At 325, we are in the restrictive territory. And of course, we should not remain in restrictive territory when we arrive at 2% in a sustainable way. Okay, so the rates should be coming down. As for the decisions going forward, I think the modus operandi that we have had so far, meeting by meeting, looking at all the data, not just specific data points, is still to be followed because uncertainty still remains very high. As for the macro, unfortunately, soft landing story is still there, but unfortunately, it seems that the growth is too slow to return. And even if we have the soft landing, we should not stay at the ground level for growth. And that's, in my view, the major problem. As for the macro, I would say, there's good, bad, and ugly. In terms of the good one, what do we see? We see that bank lending surveys showing that households are increasing their demand for loans. We also see that confidence for households is gradually increasing, and that might be a signal that the savings rate might be, finding its peak and not growing further. So that could be an early indication that consumption might start to grow and therefore drive the recovery. It's been too slow so far. Okay. As for the bad, of course, we see weakening also in the compared to the last few months in the services sector. Industry is not very rapid to recover as well. Yes, there's some better readings in some of the elements of the PMIs very lately, but the relationship between PMIs and the growth has been quite loose recently. And overall, risks to growth are still on the downside. And the worrying element here is, of course, that the risks on the downside are also for the largest Euro area economies. Let me mention just Germany and France. As for France, with the fiscal element, it's likely to shape quite a large share of the growth outlook going forward. And if it is not aligned with some structural improvements, of course, that will leave economy in a situation of less growth. And the ugly thing, it's geopolitics and the risk of tipping point in the labor market. The tipping point in the labor market, what do I understand by that? We've had in the past quite a lot of discussions in terms of the labor hoarding. If growth is slow to come, there might be risks that labor hoarding unwinds in a non-linear way, and that may kind of kick off some unemployment increase. It is not there at the moment yet. That is somewhat, risk for the next half of the year, for the next year, but I don't think that we can ignore that. And geopolitical uncertainties, things like tariffs, for Europe that is very much export oriented, of course, would not make things easier. As for growth as well, the ugly thing potentially is lack of structural reforms. For instance, the same German case, it's a mix of cyclical weakness, but also structural weakness. Unless this gets fixed, then growth will be too slow to return. This may have, again, this strengthening effect for the tipping point in the labor market. But let me stress, it's not at the moment. Okay, that is the theory, worry for the future. And let me conclude with, again, monetary policy decision-making. So of course, we have had lots of discussions, what is going to happen in December. Let me just come back to the modus operandi that we have had so far, meeting by meeting, data-driven, okay? We will see in December what we do in December. Uncertainty remains very high, okay? But the direction for the rates, of course, is downwards. Thank you.
Great, thank you. Jason?
So it's good to be here. I'll also do macro outlook for the United States. And the base case here is very good. We're growing at about 3%. The composition of that growth has improved as residential investment has stabilized and forward-looking equipment investment has picked up. The job market, which looked a little bit nerve-wracking over the summer, has stabilized at continued strong growth. And of course, inflation has come down a lot over the last 2 years. That's the base case. That's not that interesting to talk about. So let's talk about three near-term worries and three longer-term worries. The first near-term worry, and I list it first because I think it is the biggest of them, is that the last mile of inflation will be much harder than what's happened so far. There's a number of reasons to think that's the case. Just doing a bottom-up type analysis, we've been aided by a bunch of good luck. We've been aided by goods inflation, which may be temporary. The wage growth we're seeing is consistent with what you would expect in a world with 3 to 3.5% inflation. And I think people are getting increasingly and rightfully skeptical about just how much shelter or housing will slow down. From a top-down perspective, if you think in terms of something like a new Keynesian Phillips curve, inflation expectations have drifted up a little bit. The labor market is probably loose, but it is not certainly loose, and it doesn't appear to be loosening anymore. Openings appear to have stabilized. The unemployment rate appears to have stabilized, and the supply shock term has been a positive for inflation, but that's a transitory positive for inflation. Add all of that together, a reasonable guess is that underlying inflation could easily be between 2.5% and 3%. That is much, much better than it was 2 years ago. That might even be tolerable if the Fed decided to change its target. I don't think the Fed will change its target. And with its current target, that's probably intolerably high. And if that's correct, then maybe we do get 2 more cuts this year, but then is much more of an open question whether there are any more cuts next year. The second short-term risk is on the other side of the ledger, and that's recession. That has receded a lot over the last 2 months. As I said, forward-looking measures of GDP are even stronger than contemporaneous measures of GDP. There's reason to think that some of the unemployment rate at 4.1 might even reflect temporary factors itself that may recede. Things like the commercial real estate and banking situation, which had been on everyone's recession list for a long time, I think should move down in terms of how they were never really high up on my list. I think they're quite manageable, quite predictable. One always needs to worry about this. Of course, if the labor market starts deteriorating, you would get more Fed cuts next year. But I think it really will take labor market deterioration to keep those cuts going in a strong way next year, not satisfying numbers on inflation. The third near-term risk to the economy is a dramatic change in economic policy and a dramatic change on tariffs, on monetary policy, on fiscal policy, and the like. I don't think that is guaranteed with the election of either candidate. I think the base case for both candidates is something closer to continuity than to change. But I think one of the two candidates, there's a greater risk of deviation from that. Now let's talk about three long-term issues. The first and most important is potential growth. For the last 2 years, the economy has grown at 3%. Potential growth rate was possibly even higher than 3%, as evidenced by the fact that the unemployment rate drifted up over that period of time. But that potential growth that might even have been as high as 3.5% over the last 2 years was temporarily elevated in part by a productivity bounce back from the negative productivity growth in the first year and a half after the pandemic, and in part by an extraordinary surge of immigrants. Unless that productivity bounce back hands over to some other driver of productivity, like generative AI, and I think that's a real possibility and a real open question, I would not expect it to necessarily continue, and you go back to something more like 1.6% productivity growth instead of 2% productivity growth. And then in terms of the immigration surge, I think, if Harris is elected, it continues to end in the way she has ended it. And if Trump is elected, the question is, does it end in reverse or does it just end? Either way, though, I don't think the United States should expect to continue to have it. That would mean our potential growth rate would potentially downshift to something in the range of 1.5 to 2. That could happen over a 2-year period of time. How you make that transition from a higher growth rate to a lower growth rate, what you do in a world where things were geared to that higher growth rate, I think is an important question. The second longer run structural issue is interest rates. Right now, the markets are counting on them coming down, the Fed funds rate coming down to something like 3%. That happening pretty much over the next 15 months. To me, if we miss that, it's more likely that we miss it because interest rates don't go down that far, than that they go down much further to where they were before this. There's a lot of features, including stronger investment demand and higher budget deficits and debt, that would lead us to think that the equilibrium interest rate has maybe risen more than markets are expecting. And so even if the rate cut momentum continues into next year, because we do get some favorable further breaks on inflation, how much further into next year, what the neutral rate is, could be higher than both what the Fed has penciled in and markets have penciled in. And then finally, and hopefully Axel won't nod too enthusiastically as I talk about this, the last structural concern one has to be the US fiscal situation. The deficit in the last fiscal year was $1.8 trillion. That was a year that was fantastic growth, fantastic economic performance, no major emergency spending. And by the way, some timing shifts that disguise the true deficit in that year. The primary deficit is basically around 3 to 3.5% of GDP. The only real conversation that's going on about the deficit is how to increase it further, not how to decrease it. I don't think this is necessarily an instant pressing issue. You look at financial markets, they don't look as if it's an instant pressing issue, but it's basically impossible to continue on this course. It's even more impossible to continue to add to this course. And while I think most of the reason for the strong growth in the US economy over the last 2 years was temporarily elevated potential, to the degree that the large deficit in the United States, which is much larger than any other advanced economy, and it's not like France and the UK are having it easy in that regard right now. To the degree that was part of what was driving growth, that's not a sustainable factor driving growth in the future. The magnitude of an adjustment that we would need to make is about 2.5% of GDP, maybe 3% of GDP. That's something that's doable economically. Politically, it's much more of a question mark. But I'll end where I began. The base case, certainly in the near term, is very good for the US economy.
Great. Thanks, Jason. Axel, over to you.
Thank you. not speaking for any particular constituency because I'm no longer a central banker, and having spent my last years in the market, I want to focus a bit more on the journey that we've been on, largely driven by central banks and inflation, and really determine a bit what I think is ahead. And I find myself in very much agreement with at least the last 2 points that Jason made. So I don't want to dwell on that. But, you know, I think if you look back to before the pandemic, you can actually see that central banks were a major contribution because of their balance sheet policies with QE and because of very low or negative interest rates to market performance. You can see a stock market performance over the last decade that is second to none. You see a very high correlation between G7 or G5 liquidity generated by central banks augmenting their balance sheet and movements in the stock market. So one of the biggest drivers of markets has been in that period, the availability of liquidity looking for investments. Now, since the outbreak of the pandemic and the subsequent inflation, major central banks have been embarking on dual action, raising rates. We've seen the steepest, globally most coordinated, actually initiated by emerging markets, which was new to this cycle, rate hike cycle in years from bottom to top. Most central banks raised by more than they ever did. They raised rates in a faster way, and they stuck at higher rates for longer than they ever did in any of the previous post-war cycles. And I think that has been warranted because largely with inflation running double-digit, central banks were behind the curve. I don't have to go into the reason why central banks initially believed that this would be a transitory rise in inflation. Once they realized inflation was more persistent, they really acted very well. So whilst I do not necessarily give central banks a high mark on controlling inflation as it broke out, I must say that recovering from high inflation was very well done in most central banks. And as Jason just said, it's almost been an ideal path through which the US economy adjusted to higher rates in a very robust way. And you could say the same for Europe. But it was a double pivot. They also reduced their balance sheet. If you look at global liquidity generated by central banks, even the last central bank, the Bank of Japan, has now embarked on a more restrictive approach to their balance sheet. Switzerland, where I lived for the last 10 years, had a balance sheet that was a multiple of GDP. They started reducing their balance sheet. So there are some headwinds coming from central bank liquidity being less abundant in the market. We haven't really seen that impact on the stock market, except if you look at the stock market, for example, for the S&P 493, they've not done that well as the seven large magnificent firms. There's been a real improvement both in the weight of these companies and of the overall market due to a very single factor. But if you take that out, stock markets haven't really been in such a great rally as it looks at face value. Going forward, I think while central banks were surprised by the amount of inflation and it's persistent, I find myself now looking at central bank communication, which I read a bit, they're surprised a bit by their own success in bringing inflation down. For some of them, this has happened faster than they anticipated. I fully agree to Jason's remarks about the last mile. It may be more difficult to bring inflation down to 2% persistently. And the major reason for that, in my view, is twofold. The first is we've seen an increase in the price level of around 25% in most of our economies. And if you look at the wage behavior, actually wages have started to rise with a lag to the inflation rate. And if you look at European countries, some countries like the Netherlands, current wage increase of nominal wages is around 7%. If you look at real wages, the initial decline of real wages has been caught up by now. So real wages are back into positive territory and stabilizing at their pre-pandemic trend. So on the wage front and on the inflation front, I think most of the adjustment has gone through, but it doesn't mean that the system necessarily has re-anchored at 3%, at 2%. I think there is a remaining risk that we will see more pipeline inflation impact on the economies, and it will be very hard to bring inflation down to 2%. The market has, in my view, gotten it completely wrong over this year on the path of interest rates. I remember being in meetings around the turn of the year where most banks had predicted a massive decline of nominal rates. The market kind of priced in 150 basis point decline in interest rates. The market buys exactly these 150 basis point out again pretty quickly. And I was pretty much on the record saying that if anything, the interest rates this year may fall by 1%, but not to 1%, as some in the market were looking at. And I think that has been in my view, lack of understanding that while central banks have tightened policy, they need to stick it out for a while for this really to take hold and bring inflation down, which is, I think, that the good job that central banks have done. They stuck it out despite criticism of this policy being restrictive. Now, we are facing different problems on different sides of the Atlantic at the moment. And I first want to agree to what Jason just said about not just the last mile, but also deficits and debt. The US has run a wartime deficit in peacetime in a very good environment. I wonder what will happen to the US deficit if we see more economic headwinds for the economy. Nobody has any perception that under whoever will be the next president and whoever will be in the next Senate and House, you will see fiscal consolidation. You will probably see a continued high spend. And what I find quite concerning is two things. If you look at what happens to gold, the market has chosen, at least part of the market has chosen the renumeraire, which used to be, we used to have something like a gold standard. The market is now looking at gold differently. Central banks are looking at gold differently. The whole discussion around sanctions on foreign exchange reserves has really led to a complete new view in some emerging markets and other market central banks that gold is something good to have in your balance sheet because it's fungible irrespective of sanctions. And so you will see parts of the market that will behave differently in the future, given where we are now. I find it quite striking that the US as a AAA country has a cost of financing interest on existing deficit that is more in the area of a single B country or a double B country than a AAA country. And so the whole implicit dynamic of debt deficits and interest cost of that deficit will be an important one. The US has the enormous privilege to borrow at favorable cost in global markets. I think the important thing is you should never take that for granted. You saw how in France that privilege came at a higher price when there were political concerns. And I'm pretty sure that that issue is going to be an issue under the next administration. Not saying that this will be it's not a 0-1 move, but it is one where you pay more for the privilege to borrow in market and where you face a steeper yield curve, which I think is a fate that's ahead of Europe. If I look at what central banks are doing now, I think the next biggest mistake central banks could do is believe that their shift from inflation being the problem to the labor markets and the economy being the problem, that they can do something about that. I fully agree with the discussion that Jason just started about the real rate. I do think that most of the problems that economies face, in particular in Europe, are structural in nature and more driven by supply side issues than by demand side issues. And central banks may find themselves, if they refocus on the economy and their support that they can do for the economy, that they will be pushing on the string, and whatever they do will not help them lift growth, because most of the growth problems we have in Europe are structural. I'll probably talk a bit later about a country where we're just having a laboratory experiment, Germany, on how bad growth can really be if you face a lot of structural issues. And I think that's a telling story for European growth impediment. It's not demand side. It's not something central banks can fix. And I think if they try and fix that with loose policy, the other problem, inflation, might come back to haunt them. Thank you.
Great, thanks. So what I'd like to do is maybe first do a round of questions around sort of data and trajectory and where expectations are, and then we'll get into monetary policy and landing zones and R-star, et cetera. And I wanted to start maybe with you, Martin. So, the European Central Bank has had this forecast of effectively a pretty strong recovery, mainly sort of thanks to the consumer, and it just doesn't seem to be happening. And as it's not happening, it looks like the businesses are getting more and more pessimistic. You see the surveys going lower, and now obviously the ECB is talking about downside risks in the forecast. You then have potential fiscal contraction in a couple of large economies coming next year. And it just looks like the forecast you have for next year for this recovery just looks increasingly untenable unless, we do start to see that consumer recovery. So what is your sort of view on the likelihood of that happening? What are you looking at as sort of, lead indicators to maybe tell you that indeed the forecast is still viable and that we are going to see some pickup in demand in Europe?
Thank you. Before I get to this, I think Axel's point on the structural policy and central bank not being the only game in town is absolutely critical. Okay. And, central bank can give you painkillers, but it's not the dentist. And if you have a toothache, go to the dentist. Okay. Don't rely on painkillers. But coming back to the households, yes. What we've seen in euro area is that households have been slower to move in terms of their consumption. We've seen that wage growth has been quite strong. Inflation has come down quite quickly. And we see that by and large, the real wages, depends from country to country, but real wages have recovered. Okay. And that should spill over into more consumption, which is still quite timid. There are some green shoots. As I already mentioned, for instance, in terms of the very recent bank lending survey, we see that demand from households for loans has inched up. We see that bank lending standards for households have eased up, but this is still quite early stages. And what could be the reasons why households are still in many cases choosing to save up rather than spend? And there could be quite a lot of reasons for that. And again, it depends geographically. For instance, in the Baltic economies closer to Russia, one thing is, of course, geopolitical element. Okay. In Germany, France, this could be local politics. Okay. Snap elections or forthcoming elections and all these kind of things, of course, increase uncertainty as well. But there is also another element, which is the way households save. In Europe, households very much rely on relatively, if I may say so, primitive ways of investing. So it is bank deposits, it's real estate, and none of these assets have been extremely stellar recently. In the US, households are investing more in stock exchange now. So they have gained from this QE and low interest rate story in the past. And that has built their wealth much better than for their European counterparts. So it may take some time. But as I said, the good thing is that some green shoots that might be indicating that households are finally turning around, and the savings rate that has been rising over the last quarters might be peaking. Okay. Yeah, but in terms of growth, there are some cyclical elements, but mainly also structural elements. And if one takes a look at Europe, I think the European problem is very clearly too much fragmentation. If one takes a look at financial markets are fragmented along national borders. We have one currency, but we have 20 different isolated financial markets that lack scale, that lack diversity, that lack agility. And capital markets union, banking union, these are some of the elements that we would benefit greatly from in terms of the efficiency of capital allocation. But in many cases, it is not coming very soon.
Great. Catherine, I'd like to ask you sort of a similar trajectory question on growth. And I have to admit, I'm sort of most confused by the UK data in the sense that I think the first half of the year you had over 3% domestic demand growth, but then actually it was all like special factors and inventories. And as you said, consumption is quite weak. On sort of a forward-looking basis, I mean, real disposable income looks fine, but it's sort of getting saved. You still got a third of households, I think, which have mortgages to reset. You've got surprisingly manufacturing PMIs actually looking not as bad as other countries in what is a pretty open economy. It was sort of odd. So it's a very mixed bag. And so I'm just curious, where do you think, so there's some positives and some negatives. Where do you think next couple of quarters, the trajectory of growth goes?
Well, I talked a little bit about the things that I look at in order to get a read on the near term. And as I say, I think we really do need to look down below the top line numbers to evaluate the behavior of the different income deciles. Similarly, in terms of the data coming in on services and goods, retail sales, which have been pretty weak, have, and up and down a little bit, closer to flat actually, have been more positive over the last couple of months. I think we have to wait a few weeks to get some additional read on important ingredients that will be relevant for business decision-making on the one hand, as well as consumer confidence. So that, I think, is the most important factor in the current sort of going over the rest of this year. Going into the middle of next year or up through next year, again, I think we're going to have to see a lot of additional information coming in on how consumers are reacting to the change in monetary policy. Is it going to be additional cuts? Is it going to be not so many cuts? That will be very important for the extent to which consumers are saving in deposit-bearing assets. They also, the UK consumer tends to save in a bank account strategy. So let's suppose there were more aggressive cuts that makes deposit-bearing assets less attractive and potentially releases consumer demand to continue on into next year. If there were a different trajectory for monetary policy, and in addition, if there were more significant cuts, you would have a different implication for those who are refinancing mortgages. So those are two very important channels for monetary policy to affect prospects for consumer behavior. We have different approaches collectively among the Monetary Policy Committee on what we see as the structure of the economy and the associated appropriate monetary policy path. So the outline of more aggressive cuts is more aggressive pace of cuts, and the implications for consumption from that is only one view amongst the committee members. There are other views which tends to focus much more on the persistence of the persistence and the consumer behavior being more modest, and that inflation in the last mile very difficult to achieve, and that we need to stick it out for longer in order to purge the behaviors that have tended to keep inflation high. So those are two different bookends on possible strategies for monetary policy. And one is very structural. And in listening to structural reform here, I felt like I was in my previous job as chief economist at the OECD. So talking about structural reforms. So structural problems generate a need for monetary policy to be more restrictive for longer. Focus on fading away of shocks. Persistence fading would be associated with a more aggressive pace of monetary policy.
And so it actually sounds like in a particular circumstance of the UK, so I know you prefer sort of the remain a bit restrictive for longer, but that the transmission of potential cuts is a bit quicker in the UK, and that so in other countries you say, oh, the lags are long, you have to start cutting now to do something about something a year from now. But you think actually premature because you'd get the stimulus effect really before services and wages have come down enough.
Yeah.
Okay.
Yeah.
Okay.
If you have structural persistence in the relationship between wages and price formation that is persistent and embedded, then it's premature to start cutting until you purge those behaviors. And we can talk about our star too.
Which we will. So, Jason, so I mean, your opening remarks, I think, made it pretty clear what you thought about the Fed doing 50. But I'd like to get your read on the data. So the Fed thought it was seeing something in the labor market, it seems, right? And then obviously we had a sort of a bumper payroll print, and then maybe the view changed. But so I'm just curious on think a little bit again about trajectory of growth and where we're going. We're still tracking GDP about 3% or so in the third quarter. The easing has now started. We have sort of been forecasting this slowdown in growth, in part because it does look like the bottom end of the income distribution is sort of running out of money, and eventually, that's got to have some impact. But now with the Fed easing having started, the question sort of is, well, how much, does that sort of start to negate the potential slowdown that was coming? You mentioned, going from 3.5% type of potential growth to ultimately something sub 2. But how do you sort of think about navigating the next couple of quarters? Like how quickly can that transition really happen if the Fed cuts are now kicking in pretty aggressively?
Yeah, so there were a lot of pieces to that question. I'll probably just get to some of them. I was on the record that I thought they should do 25, not 50. I wasn't incredibly concerned about 50 though, because rates didn't need to be 5.25 to 5.5. Inflation is a continuous variable. I don't think it's gone. I think the inflation risk is still there, but the inflation is lower than it was. The inflation risk is lower than it was. And so the appropriate interest rates are lower than they used to be. And the idea that they needed to, over the course of this year, reduce by, at least 75 basis points seemed correct to me. And so I would have rather they started with 25. I don't think there was any unusual emergency type situation that warranted 50. But you could undo it effectively by doing less later on. So I don't think it was a very consequential error ex ante. It's a little bit more of an error ex post, still not overly consequential. In terms of this near-term adjustment, I feel better about sustainability now than I did a month ago. And I think this may fit in with the FOMC decision too. Every year, there's a benchmark revision of GDP that goes back 5 years. Every year, I sit there hoping that every puzzle I have about the data will be resolved by the revisions. And it turns out the puzzles will all have been spurious. And almost every year, I'm disappointed. And some years, they even get worse. This year was that rare year where your sort of prayers came true. So one thing was I had a gnawing fear that the economy wasn't growing as fast as we thought, because GDI was growing much more slowly than GDP, and the disconnect between them was bigger than we'd ever seen before. Guess what? It was revised. GDI growth was revised up. GDP growth was revised up, and they both look about the same. Another one, which gets to the sustainability issue, is I was very worried that consumption growth was tracking well above what we'd expected prior to the pandemic, that income growth was tracking well below what we expected prior to the pandemic. The disconnect between those was a very low saving rate, and that meant the consumption portion of GDP might not be sustainable. Well, I'm still worried. There's still reasons to be worried about it, but I'm less worried because income was revised up a lot. The saving rate was revised up some. That disconnect is less striking. It is still a saving rate on the low side. There are still signs of consumer distress growing. I think there are still cracks there, but I'm less worried than I was. And then the final thing that the revisions did was they shifted more of the growth over to the investment side, which is forward-looking, which doesn't depend on these types of household cracks and the like. So in terms of near-term demand, I think that revision both suggested it's stronger and more sustainable than we thought it was. It doesn't answer the question that may play out over something like a 2-year time horizon of how do you go from 3 to 3.5% potential to 1.5 to 2% potential. Hopefully that's just some natural slowing of the economy, but that can be a tricky thing to manage and can be inflationary in the process of adjustment insofar as people misunderstand what's happening.
Right. And Axel, rightly or wrongly, people have a tendency to look at Europe through a German lens. And right now there seems to be sort of this mingling of the near-term sort of cyclical weakness and then the long-term concerns about, how's German auto industry going to react to Chinese competition, the energy intensity of production, which is a structural problem. And I wanted to see, what do you want to validate all the pessimism, or what do you want to push back on it? Is it really as bad as it currently seems?
Yeah, it is quite bad. When I give a talk in Germany now, the title is Berlin, We Have a Problem. I think there is what I call a bit of a post-industrial illusion in our current government that is putting energy transition before energy security in a country that is largely an industrial heartland in Europe. If you want to discontinue one business model, you better have a different one to put in place, which they don't. And so what they're doing is just basically undermining the economy. And that may sound harsh, but I think it's a brutal reality on the ground, in my view. I'd like to add one aspect before going into that, and it will not be nice, it could be gloomy, but I want to add one aspect that I find quite intriguing at the moment where we stand, both in terms of central bank projections, but also government projections. If you look at current forecasts, they often remind me of this Hitchhiker's Guide to the Galaxy, where a key theme is, give me the question to which the answer is 7.
Of course, yeah.
Exactly. And that's a bit what forecasts now look like when you look at central banks. If you look at the long run of central bank forecasts, inflation is always 2%. And in Europe, long run growth is around 1.5%. In the US, it tends to be 2.5%. And most of these models, in my view, are really not a very good guidance to making any assessment around the medium to long term, because they're driven by current dynamics and how these models go back in the absence of any shocks lingering to their steady state environment. And I think it's almost dangerous. It was part of the reason why central banks were late in recognizing the problem, that they always had this optimistic forecast that in the medium term, inflation would go back. And I find that the current government in Berlin is kind of falling into the same track. Medium to long term, if you look at growth forecasts, Germany hasn't grown since the pandemic hit. The accumulated growth in Germany is 0.1%. Now, if you look at the forecast, everything looks right in 3 years' time, because they're going back to what was a traditional assessment of the medium-term growth. I don't think that's going to happen. And if you want to drill down to that, I usually look at a number that is more around Europe being 0.5% to 1% in terms of potential growth. Germany probably more at the 0 to 0.5% range in this next few years. And then you drill a bit deeper and you look at the forecast. And again, 2 years out, forecasts for Germany are 1.5%, 2%, which leads to a sense of, security with ministers that need to take action that is simply, in my view, unwarranted. One of the things that really is important, and Catherine mentioned her job at the OECD before, if you look at OECD or EU Commission long-term growth forecasts, they all kind of fall into this 1% in the long term. But the 1% is driven by historical constellations. Now, if you look at the key factors of production in Germany, for example, energy, you can see that our particular choice of no nuclear being part of the energy mix leads to the fact that German energy costs are 3 times as high as they are in the US and almost 50% to 75% higher than they are in France. So as a hub for high energy intensive industrial production, you really have a big cost factor for German industry that comes in from the entire energy backbone and how that is transitioned. If you look at employment in industrial production, it kind of moves sideways for most part of the industrial production, non-energy intensive in particular. But if you look at the energy intensive part of production in Germany, it's kind of in free fall. It has fallen by more than 40% over the last 2 to 3 years. You look at the biggest job losses we have, and I'm just reading them out. And Aaron, thank you, because that's a paper that you did at UBS. It's manufacturing, motor vehicles, basic metals, machinery equipment, all to the tune of 50 to 100,000 job losses in those industries over the last years. So what is really happening in Germany is a big undermining of the industrial base of the country. And if you look at how important the industrial base is in the country, Germany has a share in manufacturing, construction, and GDP that is about 23, 24%, double of what it is in France, because we're not a service industry, we're a manufacturing country. And that business model is really taking a big hit on another dimension too, because if you look at exports to China, China's growth has come down to something that is more around 4% than in the last 10 years, that the growth has been continuously declining. And if you look at China's role in German exports, what is often mentioned is motor vehicles. Yes, on motor vehicles, 15% is the share of exports of motor vehicles in German export, and the share of China is almost 12% of that. So most of it goes to China, but then electrical equipment, computer electronics, machinery, pharma, chemicals, other transportation equipment, all of them have export shares in China that are making up most of the export of the German industry. So we had a completely over-optimized business model that relied on cheap energy from Russia, which is replaced by very expensive energy from everywhere else. We had a business model of export focus on China, which is dying in the doors. And we had a very heavy reliance on manufacturing of high quality, durable products like cars, which is no longer the future. And to believe that any of that can be fixed in any short period of time, in my view, is a complete illusion. This requires a 5 to 10-year transition of the German economy into an area, because we've specialized on manufacturing, in which we've not been good at. Now, it's one thing if you specialize on something on which you're good and you just done too much of the other thing you're good. On the German economy, the main transition is we have to specialize on something we're not good at, and that isn't our history, and that's why it will take longer and will be more brutal. Thank you.
Great, thanks, Axel. So let's turn to the central banks and particularly where they're going and what sort of the destination is here. And I want to start with Catherine. And so one way of sort of framing the issue, rather than asking you directly about market pricing, is to talk about sort of the, how do you think about the landing zone? So, do you think that growth and inflation are ultimately going back to pre-pandemic levels, and therefore, pre-pandemic R-star sort of the right way to frame where the central banks are going, or has something changed in your view?
There are a lot of landing zone airplane analogies, metaphors, and so forth. And I might add one, but
Okay.
but not yet. So your question about what are the prospects, or what do I think are the prospects for returning to the pre-pandemic nominal R-star and its real side equivalent pre-pandemic? I mean, basically my answer is no. I think the pandemic and not just the pandemic, but the set of shocks, which we can even go back to another shock in the UK, the Brexit shock, the pandemic shock, the Russia invading Ukraine shock, and associated with energy and inflation. These are very, very large shocks to an economy. And the notion that somehow these shocks fade away and leave no residual impact on an economy is very hard to believe, especially a small open economy, which is very affected by external factors as well. So the question, will it go back, begs analysis to say, yeah, probably not. So let's go look to see whether or not we think there are structural changes in the economy that yield different relationships between consumption, consumer behavior, their wage negotiations, and associated pricing behavior and strategy of firms, particularly in a small open economy. Let's go look for the kinds of persistence, you can call it a nonlinearity, you can call it an asymmetry, persistence, embeddedness of inflation that is a structural feature for at least the monetary policy horizon, 3 years. Let's go look at structural changes in underlying labor dynamics. We have a labor force participation rate that has not recovered much since the pandemic. And that appears to be something permanent. or at least, again, for not changing enough over the monetary policy horizon. So these structural changes are embedded in the economy, and they will alter where we think the landing zone is for the nominal policy rate. It also means that when we think about the structure having evolved over the course of the last 3 years, and perhaps a little bit more, depending on when we want to start the shocks, that means that the measure of restrictiveness is less than what we thought it was. If R star is higher, then the path that we had in the past was not as restrictive as we thought if we didn't think R star had changed. So that's both a look at the past and a look at the current environment. But if I go try to do the crystal ball thing and look forward, I see an environment going forward, again, over the monetary policy horizon. So demographics are not really the story here. Over the monetary policy horizon, at least, I see a lot more inflation supply shocks associated with inflation volatility. That volatility in an environment where there's rigidity, downward rigidity in wages and prices, which is something we can determine from the data being a fact, that more shocks, downward rigidity on wages and prices yields upward bias on inflation. And that is something that will raise nominal R star at least, and is something that a central bank has to lean against. I think there are other statistical methods that we have looked at that don't constrain the forward-looking data dynamics to get to the target. You don't constrain it to get to the target of 2%. It does not get there in the monetary policy horizon. So it is not a surprise to me at all that when we ask our market folks, market intelligence, probably some of them are in the room here, that for the last 2 years at least, your estimate of nominal R star has been about 3.5. So I don't see over the monetary policy horizon the type of dynamics, both structural as well as nominal, of getting us back to the landing zone from the pre-pandemic time period.
Great, thank you. Martins, I want to come to you with sort of a similar question. So, the ECB still has this restrictive language. I don't know if you want to call it for guidance, but they want to remain restrictive until inflation gets back to target. But yet you also now have downside risks to both growth and inflation, which suggests to me that if we don't get the recovery that's in the forecast, you don't necessarily want to land at neutral. You might want to land below it. So I'm just curious how you're thinking about sort of the envelope of cuts that you think needs to be delivered here, and what for you is sort of the appropriate landing zone.
I would say nobody knows. we will see where the landing zone is, so just like touching the water, step by step, moving down the path. But it is by no means 3.25. Okay, it's still restrictive. Academic estimates, as you well know, are having very broad confidence intervals, and 2.5 up to 3%. So we'll see. Will we need to move lower than the neutral rate if the economy underperforms and that pushes inflation down? In terms of inflation, if you take a look at the services inflation, still close to 4%. So I perhaps wouldn't say that there is the last mile story in Europe. I would say perhaps the last kilometer, which is somewhat shorter than a mile. So I think we're closer to that destination, but than the end of the last year, of the next year. But where exactly it is, I think just we will see when we move step by step. Currently calling numbers, given the high uncertainty, both of the estimates of R star, given the uncertainty of external shocks, is in my view just impossible. Do we need to go significantly below the neutral rate now? I don't think so. Okay, we are not in that kind of scenario yet. That would be the negative scenario. But let me come back just to one more issue in terms of what Catherine just mentioned. And this is in terms of the geopolitical shifts. We very clearly see that this is a change of geopolitical regime, and this new regime is more prone to various supply shocks. And those supply shocks tend to cluster, which means that it's not just one shock, that, you can very easily look through. It is likely that one shock will be followed by another one. And that is also, the global order searching for the new equilibrium. That means that small players very often kick above their weight, which means that if they have their opportunity, that big player has moved, they will move as well. So it's likely that we have series of negative supply side shocks. Those supply side shocks also at one point in time might morph into demand side shocks. So the world, unfortunately, has become much more complex than the textbooks we've been using in the past. As for the geopolitical shocks as well, I think what we very clearly have to understand from the West's point of view is that if those geopolitical shocks mean that we become more fragmented, also through the tariff policies, that means that we become more vulnerable to various shocks. So our sensitivity to those shocks increases. And let me, given that I'm from Latvia, which is close to Russia, and then the Ukraine conflict is there, let me add a couple of points on this. Of course, this is not only about Ukraine winning, but I would stress two other points. This is not only about the war ending and us winning, but it's also about how the world will look like after the war ends. And if the sovereignty of small states is disputed after the war ends, then of course that is going to be a very different global order as well, instigating many more supply side shocks that are negative. So I think that is very important, not only to think about the war ending, but how the post-war world will look like. And it, of course, will have very clear economic and monetary policy implications in terms of uncertainty being higher. And then the last thing is, even if the war in Ukraine ends quickly, one should be aware of the risk of Russia continuing to meddle into our internal policies and politics. So it's not like the war in Ukraine ends and then we're back to square one. We are somewhere else. And all these elements point more to supply side shocks that are negative. And it also quite likely points to policymakers' perspective being much shorter, which means that the possibility of structural reforms being carried out is perhaps much thinner, because structural policies have the unpopular end of the stick, which is short term, and the benefit end of the stick, which is medium to long term. And if the politics become more short-termistic, we miss out on the benefits part. And that may make, again, kind of the structural policies much more difficult to be carried through. It does not mean that I'm extremely pessimistic, no, okay? But we have to be aware of these things, that it takes time, it takes work, it takes an effort. It may not happen just like that. And in terms of structural adjustment, I think Germany is in this case a very clear example. It's not going to change overnight. It's going to take time.
Yeah. I want to ask one more question of Axel, one of Jason, and then we're going to go to audience Q&A. So the one for Axel, I think I can only ask someone who's no longer at a central bank. I want to try to get you to categorize or sort of qualify what's happened here in sort of global central bank space. So if you go back a year or so ago when we were still in hiking modes, all the focus was on weakening labor markets. Now that the labor market's starting to weaken, there's like this scramble to ease quickly so they don't weaken too much. With the Bernanke-Blanchard regressions, it looks like the narrative on inflation has gone from it was in large part demand driven to it was mostly supply. You've now got sort of the Andrea Machler discussion at the SMB about, which was sort of Martin's point about we're going to have more and more of these shocks. So maybe we shouldn't look through these supply side shocks anymore, and we should be more reactive. So I want to see if I can get you. So this is not specific to any central bank, but do you sort of view the central bank analysis of what's happened and what sort of the appropriate policy responses as having shifted over the last sort of year and a half, or do you think this is all sort of par for the course?
Well, that's what I tried to say before when I said they were surprised by the breakout of inflation being so, stark. And then in a way, they seem to be surprised by their own success in bringing it down, which happened faster than many of them expect. And I think it has to do with the insight that, as you mentioned, Blanchard and Bernanke, with the insight that maybe we're seeing a lot more structural issues in the economy. And then the question being, what can central banks really do about these structural issues? And as Cassie pointed out, well, maybe if it's structural, it basically cautious. It requires some caution on the way down and the speed down, because, a large part of that will not be subject to monetary policy, but it's really structural policies. And I think in Europe in particular, the US is a much more flexible economy. And I think in the US, that is much more an open judgment. In Europe, I do think that we have major structural rigidities that continue to linger, that are actually, in my view, have gone worse with the pandemic. And therefore, it needs longer to work them out. And I made the example of Germany. It's nothing you can fix with monetary policy. On the other side, I do worry about the fact that since monetary policy is geared towards the European Union, basically Germany has lost oversight over its fiscal policy, because that's under a long-term structural restriction of a balanced budget. And even cyclical adjustments of fiscal policy seem to be quite hard to engineer in Germany, with a view of this long-term fiscal override that you have from a balanced budget rule. Now, the rule is much more intelligent than the application of the rule at the moment, because the rule doesn't require to have 0.0 budget every time. It requires over the cycle a structural position that is neutral. And countries like Switzerland have shown how you can actually use that rule and use fiscal policy over the cycle to stabilize. So I do think that maybe the reading of that part of the Constitution is a bit too much. The wording is too unclear, and it should be done by economists. It's over the cycle, and that doesn't preclude fiscal policy, in particular in a period where Germany hasn't grown since the pandemic. Now, when you look at the structural factors, and I want to end on that, on Europe, look, we are foregoing massive financing opportunities in the European economy with an unfinished monetary union, because we have no banking union, we have no capital market union. And having run a bank for many years, I mean, I get the question, what makes you what makes you lose sleep at night? I think there are a couple of issues. The first one is, I do think that central banks are underestimating the impact of interest of QT, and are underestimating the interest rate risk, in particular in view of this long-term trajectory of sovereign issuance against a demand in the market that was largely driven by bank re-regulation in the market, which is more or less coming to an end. So I think there are some structural issues that we will face on the fiscal side. I think there are structural issues we face, as I just said, on the monetary and banking union side in Europe. And the other one that I'm quite concerned about is, people ask me, well, you've been the chairman of a bank for 10 years. What makes you sleep at night? It's used to be financial disruptions. When I was at UBS, financial disruptions of the entire product chain of banks was really the top issue we worried about. I'm now active in fintech, so I'm part of the disruption. So I sleep better, because disrupting the business model of banks, if you know the business model of banks, is something that is quite interesting. But I do think Europe cannot rely on fintechs doing innovation. What Europe needs is large-scale players doing innovation. And again, it goes back to the same point. All of these transmissions of new technologies in the financial space into mainstream use by major banks is something that really worries me in Europe. That pickup seems to be stronger and faster in the US. It doesn't seem to be there in Europe. And I think Europe forgoes massive financing opportunities for its real economy by relying more and more on private equity and venture capital to drive innovation. And that is really subscale in Europe compared to the United States. So Europe really needs that wake-up call that finance is part of the solution. It used to be a problem, but it's now part of the solution. And Europe hasn't made that mind change that finance can be part of the European solution. And unless that happens, I think we will see underwhelming growth in Europe for the next few years.
Thank you. And you mentioned sort of fiscal, and that would be a good segue to get Jason to talk about the elephant in the room, which is U.S. fiscal policy. So, our own costing is that if Trump manages to carry out what he campaigns on, then you're running 7% deficits as far as the eye can see. Harris about 6%. I know other people have higher numbers. Do deficits matter? And how should we think about the ability to run these what look to be unsustainably high deficits, and how in your mind should it sort of translate to things like higher term premia, higher bond yields, et cetera?
Sure. Let me talk about that. But let me briefly address part of the premise of your question to Axel, where I disagreed with you.
Okay.
I think the Bernanke and Blanchard regressions are being misread quite a lot around the world. I think maybe sometimes at least one of the authors might contribute to that. They found that the thing that explained inflation in their model, the right-hand side variable, was Google searches for shortages, the word shortage. That we have no idea whether that's supply or whether that's demand. If you give everyone $1 million, you would see skyrocketing searches for the term shortage, and you would see a lot of inflation, and it would be a mistake to interpret that as a shift of the supply curve. That would be a shift of the demand curve. So all they tell you is that there's a disconnect between supply and demand that doesn't tell you whether demand rose or supply shrank. They do tell us something about the mechanism not being through the labor market, through other mechanisms, but there's other ways demand can affect prices than through the labor market. So I really do not think it makes any sense to think of that paper as supply, but I agree, you're not the only one that interprets it that way. That's the way it almost entirely is. When it comes to US fiscal, yes, the deficit, the primary deficit is about 3.5% of GDP. If we generously think that growth is 0.5 point above interest rates, that means you could run a deficit of 0.5% of GDP and have a stable debt. And so we're about 3 percentage points off. Continuing the tax cuts, which is the bulk of the cost of both campaigns' fiscal increases, is not macroeconomically expansionary. It's just continuing what's there. It doesn't add to that 3.5%. But what it does is miss out on one of the politically easier opportunities, not a very easy one, but one of the easier opportunities. It's easier to let something expire than to affirmatively go out and raise something. But then there is more impetus to add to this than subtract. There's certainly defense spending. There are a set of tax cut promises that have been made, and other things as well. So, largely taking the primary deficit being 3.5% or north, it can be 0.5%. And, I do think that will continue to put upward pressure on interest rates. That might be part of why interest rates are already higher in the United States than they are in Europe. And, it's hard to know what happens. Argentina had a fiscal crisis at 45% of GDP. Great Britain got all the way to 250% of GDP with no problem at all. You had the Liz Truss moment two years ago. So all sorts of things can happen in unpredictable ways. And personally, what I would do is say, don't dig the hole any deeper. Find opportunities to start digging out of it. I don't think you need an emergency fiscal consolidation, but I don't think you want to keep adding to this issue.
Okay, well, if I just made just one remark, even without referring to Bernanke or Blanchard, I think most of what you're seeing out there is structural and supply side and not demand cyclical when it comes to reacting on the economy. So,
what you mean is real GDP. I think that's almost entirely structural. What you mean is inflation. I think that's mostly about demand and monetary taking that structural as given.
Let's take some questions from the audience. Oh, okay. Okay. We'll start up front here. I'll take a few questions. We'll collect a few. So go ahead. Yeah. Is there a microphone? Yeah.
Good morning, and thank you very much. I have two questions for Mr. Weber and for Mr. Furman. I will start with you as the largest economy. We had over the past few months real interest rate on 10-year bonds higher than the potential output growth for the US economy, which is estimated by Federal Reserve at 1.8%. So we have a spillover, had a snowball effect of public debt in US. Do you see, and on the markets, on the financial markets, for the first time of the past decades, the correction in August was accompanied by the decline of the dollar. So normally when the markets adjusted in the past, we had an increase of the demand for dollars. Do you see possible, let's say, on the other hand, we have BRICS that are trying to get rid of the dollar. Do you see possible a public debt crisis in US that has already started? And do you see in this context an increase of the demand for euro, taking into account the structural challenges in terms of competitiveness of euro, in terms of global monetary and financial architecture? Thank you very much.
Okay, let's collect a few more. Sure, just one here, and then we'll go over there. Yeah.
Hi, Chris Crow from
Two here, and then we'll go over there. Sorry, go ahead. Yeah.
Chris Crow from Capula. Just a question just for whoever would like to answer it. In previous episodes where inflation's been high and it's come down, we've seen central banks cutting rates. We have seen inflation coming back up again. Is there a sort of killer argument as to why that's not going to happen this time around?
Okay, I have a question to Professor Furman and President Weber. Both of you mentioned the high debt and the deficit in US continue to rise. Also, both of you to understand that the trend cannot be go on forever. My question is, what is turning point to stop this trend? Or in another way, are there any criteria or measure to define the turning point?
Okay.
Two
Okay.
questions.
Can
One
we bring
for
one microphone over there as well? Yep.
one for Mr. Weber and another one for to Ms. Mann. So you mentioned that in the UK, services inflation needs to be around 3% to be to have inflation a target. That was the case in the past when you had core goods deflation, and you mentioned the external shocks, which probably means that core goods inflation will not be zero or negative. Do you think that would suggest that services inflation needs to be lower? And the question to Mr. Weber, what's the chance, do you think, of having Germany's debt brake reformed over the next year or two? Thank you.
Okay, last one, and then we'll do the.
My first question is for Governor Kazaks. Is there a possibility that we could face monetary policy similar to what just happened in the US? You could use a preemptive move because you still have space, but going forward, the basic question is, the pace is correlated with going below neutral or not? I mean, if you go for 50s because conditions go for it, does that mean you're going below neutral? Is that a correlation or not? And for Professor Furman, looking at what happened with the hiking cycle in US and what happened with the interest expenditures for companies, for households, what do you think about the monetary policy transmission in US? Is it working as the basic framework suggests? We are feeling only on some niches the impact of the high interest rates in the US. So going forward, if we have a slowdown for any kind of shock, any kind of reason, could the Fed do something that would be relevant on that sense, since everybody is already locked in lower rates?
Okay, thank you. Jason, you want to go first?
Sure, and I will get to some of those. First of all, will the United States need to reverse and go up? I think that's pretty unlikely. And the reason is they waited 14 months with the same interest rate because they wanted to cut rates not when they thought the rate should be 5, but when they thought the rate should be 4, in a sense, and then start gradually adjusting. So this very, very gradual adjustment basically guarantees you're behind the curve, which is a problem, but it also means that you're unlikely to have to reverse yourself. You can just adjust the pace at which you're going to it. During that 14-month period, inflation fell quite a lot. So if you were constantly adjusting with some sort of Taylor rule, you would have been cutting rates the whole time. So that's why I don't think there'll be a adjustment. In terms of monetary transmission, certainly the Fed thinks it's faster. You look at financial conditions basically fully tightened by roughly May of 2022 and have loosened over the last year by 2 percentage points. There's been some recalibration recently, but that's a small amount relative to what has happened. The IMF has some research that you maybe need to do more in a country like the United States, where mortgages don't adjust as frequently as a country like the UK, where it does. But that just speaks to how much you need to do, not can you do it. Is the debt crisis beginning? I don't think so. These are still relatively small moves within a relatively small range. There's not some discontinuity of whether the 10-year is above or below the nominal growth rate. I mean, first of all, you borrow at some blended rate with a duration that's lower than 10 years. And, if that goes up or down a little bit, I said we had a 0.5 point of deficit we could run on the primary. Maybe it's 0. Maybe we have to run 0.5 point of surplus, but it's a continuum around that, not a discontinuity. In terms of moves of the dollar, they always mystify me. So I'm not going to give you a pat answer to that question. And apologies for everything I didn't get to.
Axel, there was a couple for you, I think.
Yeah, so on whether the euro in terms of issuance will benefit from central banks and others diversifying away from the dollar, I don't think so. If you look at sanctions as being one of the drivers why central banks in some constituencies have moved away from the dollar to avoid sanction risk, European and US sanctions are in lockstep. They are very parallel. And so moving into the euro would not really be a move. That's where I think moving into gold is driven by some of this diversification of foreign exchange reserves, where you want less dollar exposures and less sanction risk. But I don't think it will benefit any major Western currency. It will benefit sort of things like gold that are not related to any particular sovereign, but are a market instrument. On the debt issuance for the US, I think, the US has an enormous privilege for funding reasonably well and at low cost in global markets. That privilege will not be a 0-1 taken away, but you will have to pay more for the same privilege. And the yield curve will steepen over time, because if you look at the long run trajectory of fiscal policy, much more than the shorter term dynamics, I'm much less worried about the short term like Jason. I'm more worried about the long term anchoring of the system. You will actually see a steeper yield curve, so the market will demand more for holding what they perceive to be a riskier asset, even if the risk is infinitesimally increasing at the short end and maybe more pronounced at the medium to long term. And the market will price it, and you will have to pay a price for that. But it's not a 0-1. This is not going to happen. On German reforms, will it happen? Look, I was on the Council of Economic Advisors under the Schröder government. At the time, the government decided a pension plan reform that Schröder did. His joke, and he could only joke about it 8 years after having lost the election, was, you guys lost me the election. But 8 years later, he saw it was the right thing to do for Germany. The Schröder reform is emburned in every policymaker's mind in Europe and in Germany in particular. If you do reform, it costs you the election. So will a lot of the stuff I talked about, which requires major reforms, not just on the pension system, but on the entire labor market, on cohabitation of unions in German corporates, I can continue to go on about what needs to change. Will governments voluntarily focus on it? I think things aren't bad enough for them to do it yet. So I think you'll see a lot more pain before they start addressing the issue, because it's very contested and it may loosen the election. Thank you.
So there's a question about the constellation of goods and services prices that are consistent with the 2% target. I mentioned 3% and 0 for goods because that was the constellation in the past. There are other constellations that would yield you 2%, probably lower on services if goods are going to be above 0. But there is another way that we can evaluate the behavior of goods and services and whether or not we're getting back to the previous sort of a situation where 2% was what we saw in the headline inflation. And that is looking at the share of prices changing in each month, looking at the extremely detailed transactions level price statistics. And one of the observations that we have made from those detailed price data is that the share of goods prices changing each month, which tends to be only about 20%. So 80% of goods prices do not change from month to month. During the period of time when goods prices were rising very dramatically, the share of prices rising was about 20% and the share falling was 0. Now we are back on the goods side to about normal, which is 10% rising each month, 10% falling each month. What we are not back to is a similar sort of exercise where we're looking at the share of services prices changing each month. And I think the first thing to observe is that when we look at these transactions level data, basically services prices never fall in both historical data series and throughout the even throughout the pandemic. So when services prices change in a month, 95% in general, 95% of prices do not change. 5% tend to go. That's associated with a services price increase of 3%. Where we were just after opening up after the pandemic is services prices, the share of services prices changing each month, rising, no falling, was about 10%. We're now back to about 7% changing each month. So that's another metric of what is consistent with 2% overall, and another way of looking about whether or not we're back to where we need to be in terms of the behavior of prices. And looking at this very detailed data is a way of getting, getting to this question of how do consumers behave, how do firms, how much pricing power do they have? How much pricing power did they have? And if the changing in consumer behavior going forward, we can track that into the transaction level prices. And that gives us a window into the prospects for inflation getting to the 2% in the medium term.
Okay. Martins, you have the last word.
Yep, thank you. As for the policy space, of course, you're absolutely right that you only have that many 50 cuts. To become expansionary, okay? And the further you go in approaching the neutral rate, who knows where it is? It's of course, again, kind of just trial and error kind of story, step by step. Then you should slow down, in my view, to fine tune, to find the level where it is. So of course, the later in the day it comes, the less the possibility that there are large cuts in the rates. And let me add a couple of other things to this one is, of course, you don't want to make a mistake and then be forced to reverse the course, because then you would mess up the market's pricing and the credibility and all related to that. So that again kind of speaks, at least for me, in favor of gradual, data-dependent, step-by-step approach. Okay, then now, if things turn sour, now, of course, one needs to look into these possibilities as well, although the probability might be quite low. Getting close to effective lower bound is no fun either, given where the fiscal policy currently stands, what happens with the debt levels and all these things. So when monetary policy starts to lose traction, at effective lower bound, the fiscal would need to join in, and then the question is how much, and then all again related issues to QE. We've been there, we've done that, and I think that the effective lower bound and reversal rate most likely is lower, because the transmission next time, if we would need to do something like that, would be better, because simply we've been there, we would use better communication. And for instance, in terms of Denmark, we've seen that negative rates can be passed on to customers also quite effectively. But I don't think that we would make it as a base case to go there. Okay, thank you.
Great. Thanks very much to all the panelists for excellent and interesting comments. Please join me in thanking them. They're out of time. We'll move on to the next one. And I think of the night, there's a response rehearsal.
Good. You've been busy, I guess.
No, when I. One more days. I almost can't wait for things. Sorry, I thought it was like a coffee break. Hi, where Charles? Sorry. Sorry. I thought it was like, I had like a buffer, but I was, then I looked at the schedule, I'm eating in here.
He said we could run a 5 minutes.
Okay.
Are you in different order or?
We can help anything, let me know.
And that's why I'm saying, so I verify what you have to say. Spillovers from,
It's here? Yeah, the minute here. Okay, good morning again. Take your seat, your coffee, and we will start in 1 minute, please. Thank you. Thank you. Thank you. Thank you for.
Charles, by the way.
Hey, Charles, nice to see you.
Yeah, I mean, when you got relaxed, yeah.
Okay, again, good morning. Welcome again to the Global Macro session. Now, this is going to be the panel on US elections chaired by Jonathan Pingle. Jonathan, thank you, and over to you.
Thank you very much. I will go slowly while everybody's mulling around the room. But thank you all for coming. This is going to be a fantastic panel. I'm actually quite honored. We're going to try to cover, 3 basic buckets before we turn it over to audience Q&A. Essentially, we're going to start out. The elephant in the room, or the mule, is the presidential election and what we're thinking about the outcomes. Then we'll move on and hopefully get a few minutes to think about, what happens afterwards. What's looming ahead, and what happens under the potential outcomes. And then third, I wouldn't mind trying to get the panel's thoughts on longer term issues. But I'm quite honored to have such a distinguished panel here. To my left is Charles Myers. He's the chairman and founder of Signum Global Advisors, a incredibly useful consulting firm for us to understand what's happening in global politics and events. He's got extensive experience advising candidates at all levels, including Hillary Clinton and President Biden's campaigns. Former vice chairman of Evercore ISI, long history and career in capital markets, as well as all of the, how should I say it, expertise he's lent to candidates over the years, as well as elected officials. On my far right David Jolly, former U.S. representative from Florida's 13th Congressional District, after having previously served as the general counsel to your predecessor, and you were an intern. So you've run the gamut
Run
in
the gamut,
Congress
that's right.
from intern to member, which is pretty impressive. Attorney, a political consultant, also a stint in finance. He is a regular contributor and commentator on a wide range of broadcasting outlets, print media, newspapers, magazines, and has a book underway. Michael Needham, honored to have you here, chairman of American Compass, a think tank committed to restoring economic consensus that emphasizes the importance of family, community, and industry to our nation's liberty and prosperity. He is also the executive director of America 2100, which advocates for policies to reinvigorate American industry, community, and patriotism. He was chief of staff to Senator Rubio and played a lead role from conception to passage in the Paycheck Protection Act, which was one of the more remarkably successful programs during the pandemic. You were chief executive officer at Heritage Action, and at the Heritage Foundation, you're also director of Asian Studies Center and chief of staff. Recognized in the inaugural Politico 50 list of thinkers, doers, and dreamers who matter, and also a frequent contributor to a variety of media outlets. And I wonder what I have been doing for my career. So turning to the looming issue that is within 2 weeks now, let me start with Charles. Since you actually are doing this for a living now, who's going to win?
Thank you. Thank you, Jonathan. Thank you, UBS. I'm very happy to be the token Democrat up here on the stage. I do think Harris wins. Our base case is for a Harris victory with divided government, divided in the opposite way of today. We think the Republicans take the Senate, the Democrats, the House. The markets, as you all know, have already moved to and have priced in, I would argue, a Trump win. Whether it's the betting markets, which I think are being just somewhat distorted, the financial markets, and I think also just having been on the road now for 6 weeks around the world, seeing clients, it is a pretty broad consensus on the buy side that Trump is going to win. And I understand that. The reason I think Harris wins is twofold, just at a high level. First, we have roughly 3% undecided voters in this country, including in the swing states, around 3%. I would argue, in fact, now that we're 12 days away from the election, that 3% might even be lower. As a quick aside, not only is 3% an all-time record low, but the reason for it is that every American has a view on Donald Trump. You either love him, you hate him, or you're somewhere in between, but you have a view. But because of the record low number of undecideds, the strategy on both sides is much less about converting those undecideds than it is about turning out much more of your own respective bases. And this is where I think Harris has the advantage. She's a much bigger driver of turnout of the three key Democratic constituencies than Biden was, of women, Black voters, and young voters. I think 12 days from now, or when we finally have a result, we will look back with the benefit of hindsight and realize that we had, if not record, near record turnout by women, and much higher turnout than expected by young voters in this election. Lastly, just very quickly, the entire election is going to come down to Pennsylvania. As you all know, we have 7 swing states. I always say it's pretty remarkable in a country as large and as sophisticated as ours, the entire election is going to come down to Pennsylvania. Today, Harris and Trump are tied. It is a toss-up. Keep an eye on 2 counties within Pennsylvania, Erie County in the north, Chester County, part of the Philly suburbs. There's a lot of good data, publicly available data on everything from early voting to polling even in some of those, in those counties. Those 2 counties are going to tell us which way Pennsylvania goes. I think Harris wins Pennsylvania. I think she wins the White House.
That's out of consensus. That's
yes,
great.
it is.
We had a dinner last night. I did a call with a pollster. The late breaking consensus seems to be definitely for former President Trump. Mike, let's turn to you. You were talking on our prep call about some of the early voting, some of the results coming in. What are you seeing in the landscape of the campaign? What are you thinking in terms of the odds of the outcomes?
Yeah, I guess I get to be the voice of the conventional wisdom that President Trump's going to win. I think if you look at Pennsylvania, 80,000 vote margin in 2020, you had about 1 million advantage in registration for Democrats there. That's now down to 300. Absent early vote is coming in very strong right now for Republicans in Pennsylvania. If you look at the Senate race, where Senator Casey has an ad up tying himself to President Trump's tariff policy, that's not what a Democrat who thinks he's in good position to win is doing. His closing ad that he just put up is a vicious attack on Bridgewater and the anti-woman culture that the ad tries to distort Bridgewater as having had. That's not a confident ad that comes from a Senate candidate. And so I think if you look at the McCormick-Casey Senate race right now as pretty much a toss-up and assume that President Trump is running about 1.5 points, 2 points ahead, which I think is a fair assumption. I think Pennsylvania does look good for President Trump. In North Carolina right now, you have 1 million votes who've come in early, a state that'll end up with about 5.5 million people voting. It is 6%. The electorate is 6% more people over 65 than it was in 2020. It is 2% more male than it was in 2020. It's a whiter electorate right now. And so I think the early returns in North Carolina look better for President Trump than they did in 2020. Across the nation, you look in 22 where the RNC did a terrible job with a ground game. Pretty much the only two states that Republicans had any ground game in 22 were Florida, where Senator Rubio and especially Governor DeSantis, with some of the money he could raise in state, personally invested in a ground game, in New York, where Lee Zeldin did an incredible job with the ground game. The rest of the country had basically no Republican ground game, and you see the opposite in that in terms of the results that are coming in right now in the early vote. And so, look, it's going to be a close election. It's going to be 60,000 people in North Carolina. It's going to be 80,000 people in Pennsylvania. It'd be crazy to be confident. But with that kind of throat clearing caveat, I feel pretty good about President Trump's chances.
And are you looking for a red sweep?
Yeah, I think the Senate will pretty confidently be at 52 with West Virginia, Montana, and Ohio coming in. As I said, I think Pennsylvania is kind of a coin flip right now, and I think there will be some degree of correlation with Pennsylvania and the results in Wisconsin and Michigan. And so I wouldn't predict that we get those two seats, but I think that they could err on the side of Republican more so than people are anticipating.
Then the House?
I think the House is a coin flip. I guess traditionally you would say that if the Republicans win the White House, that it'll have coattails. But do we live in a time of coattails, or do people want to have a check on the White House? So I think it's
the House. I think the House is going to go flip Democratic. The Democrats only need to win a net 4 seats. Harris actually helps down ballot in the House. Especially in New York and California races. We'll win a minimum of 2 back in New York, probably 2 in California, and a few others. So I think the Democrats probably take the House by a net sort of 8 to 10 seats. I agree with you on the Senate. I disagree on Sherrod Brown. I think Sherrod Brown keeps his seat, but West Virginia, Montana definitely go Republican with that. Even if Harris wins the White House, the Republicans have the Senate.
Hey, David, can I go?
Do I get to arbitrate this? Or?
Yeah, you don't have to arbitrate it, but someone who's stood for office,
sure,
you're so well connected. You talk to everybody. What are you hearing and thinking? What are the issues? And what's left? And what's left? I mean, what's going to make the difference in this sort of final 2 weeks? I mean, what are you thinking about?
Yeah. So in full disclosure, I left the Republican Party in 2018. So we've got Democrat, Republican, Independent here, and I frankly love being untethered from partisan politics in many ways. I actually come down, I would say I would rather be in Vice President Harris's camp today than in Donald Trump's. I agree with the coin toss, everything that's been described. Largely, I agree with everything. For a couple of reasons. And first, if we take a step back, part of the tension in the American political system, not the negative partisanship tension, but the tension every cycle is, the reality is we have a system where you have 2 minority parties chasing a majority coalition in a winner-take-all state for winner-take-all stakes. National Democrats are somewhere in the high 30s, National Republicans somewhere in the low 30s. About a third of the country identifies as independent. Many of them traditionally perform as R's and D's. But the reality is there's a coalition that parties have sometimes taken for granted or sometimes chase if they feel like they really need to chase it. And so the tension is we're undergoing a bit of an evolution and a remaking, a reshaping of
both major parties of the Democratic and Republican Party. I think the Republican Party over the last decade, it's clear there's some permanency to how it's been remade. That coalition is coming into play, and you're seeing Republicans take, and sometimes traditional Democratic voters, particularly in the blue wall states of Pennsylvania, Wisconsin, Ohio, that in the past may have performed for Democrats. Democrats have been figuring out their coalition. You know, it's just 5 years ago. Are we going to be a coalition that is super progressive, where then Biden comes on, and is it the Soul of America coalition that feels maybe a little more moderate at times? And now you're seeing Vice President Harris build her coalition by actively trying to recruit Republicans, disaffected Republicans over. And that block of disaffected Republicans is trying to decide, can I really be part of a Democratic-led coalition? I mean, arguably, the only majority coalition in the country right now is an anti-Trump majority for a variety of different vertical reasons. They're all very different. And there's not permanency to that coalition right now. Many of them would be happy to be Republicans under a different person. Some of them still might say, well, I prefer Trump's policies. So how do you distill all that? The reason I say I'd rather be in Harris's camp right now is since 2016. When Donald Trump lost the popular vote but won the Electoral College, same rules in 24, which is why he very well might be president again. Democrats have overperformed in every cycle. In 18 and 20 and 22, Democrats have overperformed. And there have been voters that we've tried to figure out in hindsight why that was. Who were they? If you just take, and I don't want to jump on the toxic issue of reproductive freedom, life, and so forth. I just want to use it as a statistical example. That's an example of an issue where evangelical white Republican women who sit in church pews on on Sunday mornings, who would never identify themselves as pro-choice, even to themselves, much less to a pollster, show up. And they're just not in data, but they show up on election day and they vote. This is a presidential election, a contrast between two candidates. Issues matter a little bit less. This is an adjudication of Donald Trump and what you think of Donald Trump. But there will be a demographic that decides this election in a very small way. We discussed on the call, is it your white labor voters who traditionally have been with Democrats but show up for Donald Trump? Is it your disaffected Republicans that show up in sufficient numbers in swing states? It will be decided at the margin, but there is a question of which of one of those verticals will ultimately swing this election. Given the history of the last 6 to 8 years, I'd still prefer to be in Vice President Harris's camp than Donald Trump's. And I think there's unanimity finally on the Senate going Republican. Anything could happen, but a Donald Trump win, Republicans have the Senate because West Virginia is given and JD Vance would be the tiebreaker. I mean, it's kind of that easy in some ways. A Harris win, you need 2 seats, but that seems attainable given everything on the board.
Yeah, I mean, in terms of the Senate race, it's been interesting living in Maryland just because of what Harris really did to, in fact, in some ways, the Senate race, because it becomes a massive enthusiasm gap between the two parties. Whereas when President Biden was on the ticket, there were real questions about what the turnout would be. I mean, I'm a big fan of Larry Hogan, but he's got an uphill battle with the head of the ticket. And if it's also going to add to some enthusiasm amongst the Democratic base, becomes a bigger uphill battle. And in fact, Mike, I want to turn to you on that point, because a lot of what we're talking about is who gets who to the polls. And, are the Republicans going to turn out? Is President Trump going to, get the marginal Hispanic and Black voter that have seemed to break his way? And then what are the issues that are really going to drive, the Republicans to the polls to put him over the top, in contrast to some of the motivation on the Democratic side of the aisle?
Yeah, well, I mean, Republicans are going to the polls. We have the data, as I referenced, and we're seeing it. Historically, Republicans underperform their polling with Blacks and Hispanics. I expect that. I think that we'll have a relatively good cycle in terms of minorities voting for Republicans, but I don't think it's going to be 20% of African Americans voting for President Trump or anything that you're seeing. The largest gun purchasing demographic in the state of Pennsylvania right now is women in the Philadelphia suburbs. Philadelphia has one of the biggest crime problems of any city in the country. Pennsylvania has a gigantic fentanyl problem right now. The border matters in Pennsylvania. And so I think when you look at the issue set, just obviously people look, whether he deserves credit for it or not, to the 4 years that President Trump was in office. And the economy was performing better for people. The world felt safer. The border was under control. And that hasn't been the story for the last 3.5 years. President Trump's approval is higher than it's ever been. It is much more difficult to make somebody who's had 2 assassination attempts and is leaning out the drive-through window of a McDonald's, looking like Ronald McDonald, into the scary figure that they were able to make him into in 2016 and 2020. And so I think you will see Republicans turn out. I think the issue set plays well for Republicans. And I think it is much more difficult to convince people that Donald Trump is a scary fascist than it was for the media to paint that picture in past election cycles.
Can I mention
So-
one? Yeah, sorry, go ahead.
Go ahead.
I was gonna add one more thing just on the election. You know, our politics, as you all know, have been completely turned on its head, right? Like, if you really think about it, today, I've been covering Washington for 35 years. I would have never in a million years predicted Dick Cheney and Liz Cheney would endorse Kamala Harris. I mean, that's how really our politics have completely been turned upside down. And at the same time, I would have never predicted Bobby Kennedy Jr. endorsing Trump. Now, Tulsi Gabbard, who is a certifiable lunatic, doesn't surprise me. But just to say, and you served probably with Congresswoman Gabbard, Tulsi, but at the end of the day, there are so many unusual things happening in our politics. Also, Donald Trump has hijacked the Republican Party. Now, I know the far right's happy about that, but there are a lot of Republicans that are really unhappy about that. And as part of that, I would just say that today, you know, the Republican Party is the party that is anti-free trade and isolationist, and the Democrats today are the party of free trade, and we're the hawks, right? I mean, our politics are just totally turned upside down on the issues. And I raise that to say that, again, conventional wisdom, consensus, the betting in other markets today show a Trump win. I would just be very careful with conventional wisdom and consensus. Polling certainly is not going to help us. Polling's been so off in 16, 20, 22. Anything can still happen. But on the issues, I did want to just pick up on something. You know, the issues do matter perhaps a little less, because I do think this is a referendum on Trump more than probably anything. But on the issues, the number one issue is the economy. And yes, Harris is getting hurt on cost of living or inflation. I think, you know, de facto, she is getting some credit for the soft landing. Certainly the labor market's holding up relatively well. Price of gasoline is at an okay level. But the number two issue in this election immediately bifurcates, as you all know. If you're a Republican, border security is your number two issue. And if you're a Democrat, it's women's reproductive freedom and or the defense of democracy. You know, they get conflated. They're actually separate issues. Democrats feel equally passionate about those two. For Democrats, border security is number 7 or 8 priority. The reason is just in a very straightforward way. We do not have a crisis at the southern border. We have a manufactured political narrative of a crisis, but we do not have millions of rapists, terrorists, and murderers crossing our border every single day. We have far too many people crossing our border illegally that are very poor from Central and South America looking for a better way of life, and a few bad apples in there. Having said that, half the country believes it's a crisis. But my point on this is, at the end of the day, when we have our election result, with the benefit of hindsight, when we look back, we will find out which was the bigger driver of turnout. Was it border security, or was it women's reproductive freedom and or the defense of democracy? I'll put my money on the latter any day. And on the issue of women's reproductive freedom, the only people who actually will say either Americans are tired of this issue or it's really not really on the ballot are men. Ask American women how they feel about this issue. It is a very big deal. And lastly, in Arizona and Nevada, there is an abortion access initiative on election day in those 2 states. I wouldn't be surprised if Harris wins both Nevada and Arizona.
So we're going to come back. I want to talk about, you know, how Donald Trump has reshaped the party in a minute. We had an interesting conversation of what the Vance pick means longer term. But before we go to that, you know, on the border, though, I mean, a crisis is going to be relative to who you ask, right? Because for, you know, cultural issues and other reasons, you know, Americans might feel like might not be all about the crime. It has been a relatively large change that has appeared to really affected the American psyche over the last decade. But when we think about these last few days, Charles, what are you watching? I mean, what can change? I mean, is this written? I mean, we've got, you just described voters getting out because of reproductive rights or the border or referendum on Donald Trump. You've only got 2 weeks left. I mean, can it change? Are there any undecideds that can be moved? What moves them? What breaks here?
Look, I think there's literally 12 days to go. So it would have to be a pretty big October surprise to change on either side, to change the course of the election. Also, as of this morning, 25 million Americans have voted. To put that in perspective, 155 million voted last in 2020. So we've got about 19% of the voting population, assuming it's flat over the last cycle, that's already voted. Every day that goes by, any October surprise has less and less of an impact, right? I actually think we will have higher turnout this cycle than we did in by the way, 2020 was a 3-decade high in terms of turnout because Donald Trump was on the ballot. I think this cycle will be even higher. And I think, again, the biggest surprise will be even higher than expected turnout by women and young voters. Again, we'll see. Young voters don't participate in polls. I have 4 Gen Z kids. Like they're frustrating on every level, but they won in our election. They actually don't really participate in polls. So we'll see. But what could really change? Look, if Netanyahu, if Israel bombs Iran and Iran declares war and the United States has to enter the war. Again, for all that to happen in 12 days is probably a lot to really take on, but
that would be a lot.
It would be a lot, but
the Cheneys would be excited.
Yes, well, exactly. The price of oil would clearly spike. Price of gasoline would go up. Could that hurt? Relatedly, President Trump is absolutely seen as stronger on national security. That would also help him. So, we'd have to see a major blow up escalation in the Middle East, not totally out of the, question, but that could be an October surprise. I'm assuming this is off the record or at least Chatham House rules, but one of the Chatham House rules, that gives me zero confidence, by the way, but I've never seen more shit leaked under Chatham House rules than anything else, but I'll say it anyway. There has been a fair amount of trepidation or concern on the Harris campaign about Governor Walz. He was not very well vetted. She had to make a decision very quickly. Could there be something in his background, financial or other, that could come to light that might be negative? Quite possibly. On the other side, I always say on Donald Trump, I think we probably know just about everything and probably a lot more than we ever wanted to know. So I'm not sure there's too much new that could come out there. I think in the next 12 days, where we go from here is both candidates have to speak to the press. They're going to do a fair amount more campaigning, but really it's about the ground game in the swing states and getting people to the polls. I think on that issue, the Democrats also have a much better ground game. We'll see, but I'm not expecting a major October surprise.
So Mike, just last thing, you've been watching some of these numbers carefully. What are you watching in terms of, or what do you want to see? What would give you comfort in terms of whether it's watching the mail-in ballots counted in which states, any polls you're thinking of, any numerical markers between now and the election?
Yeah, I mean, I think, as I've said, I think the early vote's coming in well. The polls didn't get 2020 right. I'm not sure anybody knows whether it's COVID, what the cause was. And so I'm not sure what to take in the polls. What you do hear from both Republicans and Democrats is that internal polls tend to look better for Republicans than the public polling does right now. To me, this election has the vibes of the 2012 election in the opposite way. There were plenty of data points for all of us in the Republican Party to convince ourselves that Governor Romney had a chance to win. There were probably some points of time right after the first debate where Governor Romney would have won if the election had on that day. But kind of looking back on it, Barack Obama was always a significant favorite to win. And I think that when we look back on the 2024 election, we're going to realize that President Trump was the favorite pretty much all the way through. That there's enough data to convince yourself that Vice President Harris can win, that there may have been some points in time over the last couple of months that she would have won if that had been the day, but that there was a strong tilt in this election towards President Trump.
All right, David, so we've got these two candidates. What do we look for after they're elected?
Yeah.
What do we do?
Yeah, let me jump on this last question for just a second, then we'll move to looking forward, because You do, I think Charles referenced turnout voters and persuasion voters, and this is really a turnout race. You get your most intense voters to turn out. I do think among the undecideds, though, it is that soft Republican vertical, and we've seen it in the last 2 weeks where Vice President Harris has gone after them. And I talked to a lot of these people. One of them yesterday driving to the polls, I don't know what I can do. I'm not going to vote for Trump. They ended up writing in somebody else because they couldn't vote for Harris either. There are Republicans happy to vote for Harris this time, but not again. But this group, whatever that is, 1%, 2%, 3%, still remains undecided. So the soft Republicans in Lancaster County, Pennsylvania, are people you're trying to reach right now if you're Trump or you're Harris, in addition to try to turn out your intense voters. Going forward, look, every candidate brings strengths and weaknesses. I don't mean this with any disrespect, but I think it's clear neither candidate is a policy wonk. There's not a bold policy agenda sitting in front of us in 2025.
Yeah.
I think if the Senate does indeed go Republican, the Senate will be the beast in this town for 2 years. And the issues we know that the administration will face and the Senate will opine on is foreign policy, both with Russia, Ukraine, and then the Middle East. And though Senate Republicans don't really like to admit it, and the Biden-Harris administration doesn't really like to admit it, they kind of see the broad contours of foreign policy exactly the same way. I think there will be some pressure on, do we wind down support for Ukraine? But I don't know that that's where the West, broadly speaking, will be. I think they're in it until the end. But foreign policy will be an area between the new administration, either Harris or Trump, in the Senate to figure out. The expiring tax cuts in the U.S., we know is a given. It's inevitable. They expire at the end of 2025. Most of those are personal tax cuts. The corporate tax cuts don't sunset, but there will be debate over the tax cuts. If you have a Trump presidency, I think you see two really big issues. One is he's pledged to enact tariffs, whether targeted or not, we'll see, by proclamation, which he's allowed to do. And it will be interesting how Senate Republicans react to that. I think a majority of them generally would oppose broad-based tariffs, but Donald Trump controls the party. And we've seen leaders on the Hill change positions based on the direction that Trump wants to go. But then also for this room, I think Donald Trump is going to try to crush the Federal Reserve. I think he's going to try to crush the independence of the Fed one way or another. He is someone who believes free money, cheap money drives the economy, and he doesn't worry about the secondary, tertiary effects. He's built his entire career on cheap money, either by favorable deals or just not paying it back. And he knows he can make this economy white hot for several years by figuring out how to drive it down. It becomes a structural challenge how to do that. Many people have wargamed, how can he actually take greater political control of the independence of the Fed? The most likely scenario some have opined is nominating a year out, nominating shortly after his inauguration, the chair candidate to be the chair candidate for a year to try to take control of the political conversation. The question again then becomes, what does the Senate do with that? I mean, that is something anathema to the traditions of the Senate to allow a president to try to do that. But I think we're going to see that fight because the one way he knows how to turn the economy around is cheaper money. Excuse me, if it's Harris, I think you see a more traditional domestic policy agenda for Democrats in healthcare and labor and education. I do think she tries to reopen the corporate tax rate. I think that's something that she would want to revisit. But again, then the expiring Trump tax cuts become a real political football as well. Those issues inevitably will consume. Foreign policy will do it and the expiring tax cuts. But depending if you have Trump or Harris, we're going to see a very different tango between the administration and the Senate.
So Mike, so put yourself in the position of thinking about the Trump agenda, how a Republican White House would govern, what they accomplish, what the goals are, 25, 26, if they've got a, say, 52-seat Senate and maybe slim majority in the House versus divided government. What do you think?
Yeah, I mean, I think first tax reform has to happen with the expiring tax cuts. There are not the votes in the House in a narrow Republican House to do a $5 trillion extension of all of the tax cuts. And so you're going to look at something smaller. I think if you ask the average corporate person in downtown Washington, D.C. what to do with that, they would say, let's do a 4-year extension and kind of cut the cost that way. I think there are more creative ways to do it. You can look at what gets extended, what doesn't. You can look at other forms of revenue. Tariffs are a revenue. And so I do think there's an opportunity for the Trump administration to work with the Congress on including some tariff revenue in an extension of the expiring tax cuts. Once you get tax reform off the table, obviously you'll have something going on immigration. 4 million low-wage migrants coming across the border or coming through our broken asylum process isn't just an issue of crime. It's an issue of social services. If you don't believe me, ask Eric Adams. It's an issue of culture. And so the Trump administration will obviously do something on that. I think you'll have something on industrial policy, looking at rare earths, the need to win the race for AI and quantum in great power competition with China. And most importantly, you'll have Supreme Court nominees who come down. Clarence Thomas is 80, Sam Alito is 75. You never know when one of those happens, but it absolutely takes over this town when they do. It sucks up the most valuable commodity in the Congress, which is Senate floor time. And so you don't know when those Supreme Court nominations will happen, but I'd be surprised in 4 years of a Trump administration, and frankly, in the first 2 years with a tough Senate map in 2026, if you don't have at least one Supreme Court nomination that pops up.
And the Federal Reserve?
Well, look, I mean, there was a rumor a couple of years ago that Trump was going to put Steve Moore on the Federal Reserve, and that got knocked down pretty quickly in the Senate. And so I do think there's an institutionalist element in the Senate, and that something as large as David is suggesting probably isn't going to happen. And I think there's a valid case to be made that the Federal Reserve is making policy decisions that impact Americans and American workers, and some sort of change to that relationship isn't completely untoward.
Can I just jump on that a little bit? Because I think it's a very relevant topic here. And I hope that's the case. I hope the Senate and traditions and the independence of the Fed wins out. But this is where Donald Trump is a very non-traditional leader, unconventional leader. And it's not just the political tools and going to the Senate and nicely asking for reforms of the Fed. It is a toxic personal attack on the sitting Fed chairman for a year that creates security risks to him, that creates a media platform across the country that make it untenable for the Fed to survive a year, given the ability of the Trump movement to launch an attack on them. That creates a very different environment politically, as well as what does it mean for the structural integrity. I hope it doesn't play out, but from Steve Bannon to everybody else in Trump's orbit, this is something they've declared they want to do. And I think Trump is going to become increasingly impatient with the traditional work of the Fed. I think it's unfortunate, but I think that's what we would see.
Can I ask you, Charles, if we have President Harris, divided government, what does that agenda look like? How does she govern? I mean, how would we think about the priorities, particularly in the renegotiation of the expiration of TCJA?
Yeah, I think actually I want to pick up on the Fed very quickly. Project 2025 is really interesting to me, and actually some of you were at a dinner that I spoke at last night with one of the main authors of Project 2025 that Trump fired because Trump can't run far enough away from Project 2025 because it's been a political liability. But as part of the core recommendation of that, and I think therefore heritage, is not only to abolish the Fed, which is obviously ridiculous, but also to take away one of the a part of the dual mandate and to eliminate the full employment mandate of the Fed. And then within Trump world, they're also talking about a shadow Fed chair, whether it's Scott Bessent or someone else. I just want to say that all of that is really some of the most unorthodox, incredibly poor economic, some of the worst economic policies you could literally construct, and you would think that we're in a banana republic if we ever get there. So all I can say is I give President Trump credit for running fast. Hopefully he keeps running as far away from Project 2025 as possible. And I agree, by the way, that the Senate is a more mature, rational body, and they're not going to confirm. It will be a Republican Senate. They're not going to confirm the Judy Sheltons, and I disagree. I think Steve Moore could get through a Republican Senate, but they're not going to confirm people like Judy and a few of the other crazies that Trump might like to have on the FOMC. On Harris, I would just say if she wins, she's running on continuity, ongoing implementation of the CHIPS, IRA, and infrastructure bill. There will very likely be a CHIPS 2.0. We could see that under Trump as well. It was at 55 billion. It's 2 times subscribed. It's very bipartisan. I think that Harris, if she wins, will surprise people in 2 ways. Domestically, she'll be much more centrist than people expect, much more moderate, for 2 reasons. One, with a divided Congress, she's going to have to negotiate. She's going to have to compromise, meaning I think a lot more of the Trump tax cuts that expire next year will be extended and by a Harris administration, because she's going to need to probably concede some of that in order to get the debt ceiling lifted. Debt ceiling suspension expires Jan 1. With extraordinary measures, we get to April or June. It's all going to be connected. I think a lot of the Trump tax cuts do get extended under Harris. The second reason I think she'll be more moderate is if you look at what she's running on, and you can call it opportunistic or not, but where she is today is in energy policy, for example, running on all of the above: fossil fuels, fracking, and the transition to renewables. And lastly, I would just say that in the United States, as you all know, we have never elected a left-wing president ever, let alone in modern history. And I can tell you, not only that, we've never re-elected one that became left-wing or incredibly redistributive in office. So if Harris wins, in fact, her #1 priority, and I've been spending quite a bit of time with her over the last 3 or 4 months, including at our convention and in New York 3 weeks ago. If she wins, her #1 priority will be to get reelected. Literally, she's actually obsessed with this. She does not want to go down in history as a one-term president. If that's true, it means that most decisions she makes in office will be with a view to getting reelected, and it will keep her in the center. She will be far more centrist, pro-tech. Lena Khan is gone. Gary Gensler's not going to be Treasury Secretary. I think she'll surprise people at how centrist and pragmatic she is. In foreign policy, she'll be much more hawkish than people expect. She's more committed to the defense of Ukraine than even Biden is. And in the Indo-Pacific, she wants to turn AUKUS, for example, into the NATO of the Indo-Pacific, incredibly threatening to China. But I think overall, in a way, if she wins, she might even govern like a Republican.
Just as a minor plug, Arnd and I have a lengthy document online on the history of the White House and the Federal Reserve, including details of the Supreme Court precedents and potential levers of influence, just FYI. So I want to talk about, you mentioned what, the Vance choice as VP sort of means for the future of the Republican Party. David had, sort of talked about, how the party's been reshaped with the emergence of Donald Trump. I was curious what you're seeing in terms of some of these longer run themes in U.S. politics, as well as the future of the Republican Party, and what these things symbolize for economic policy going forward.
Sure. I mean, I think JD's pick as the vice president is a policy focused pick that shows a direction that the Republican Party is moving on economic policy. The average Republican voter thinks neoliberalism has failed our country. I think the average Republican voter is right. Manufacturing productivity is down over the last 10 years. It literally takes the United States more time to manufacture something today than it did 10 years ago. America is running trade deficits my entire adult life, not just trade deficits. We have a trade deficit in advanced technology. It is not the case that other countries are making the cheap stuff and we're keeping the high value stuff. China is marching up the value chain of every single industry that's in the Made in China 2025 industrial policy report. In 1984, the average American worker could support the basic needs of a household in 40 weeks of work. When I graduated high school in 2000, it took 52 weeks to do that. Today, it takes 64 weeks to do that. You cannot make ends meet on one American wage. And so our country has blown its inheritance over the last 25 years. And there is no chance that the Republican Party is going back to the economics of Paul Ryan. The question then is what happens from there? And I think it's very encouraging that somebody who has a coherent economic vision like JD is inheriting it, because if he doesn't, the other options are something that looks like rank populism. We can all figure out how to turn our compensation into tips so that they don't get taxed in the future. Or it looks like something much uglier in terms of some of the ethno-nationalism that you see going on in the country. And so I think that With JD, you have somebody who has a clear vision of an economic policy that is built around the productivity of American industry, is built on getting the balance right between worker power and capital, understands the importance of family and the demographic challenges that our country has. And that is going to be something that's much easier to work with, to influence, and to anticipate what direction it's going to go than the other options of what fills the void left by the failures of neoliberal economic policy.
So David, that is a shift from the Republican Party that you were also known for reaching across the aisle. But, if I think back to, sort of the two Bush administrations, you saw some of the evolution in that direction, but it really was, an inheritor of kind of pro-business, free trade, liberal markets. So, thinking about that and the political divide, I mean, how do you assess the state of, the divisions in economic policy and direction going forward? And how do we carve a more unified path here?
Yeah, so I agree with Mike. I think there's permanence to the Republican Party change. It didn't just happen with Donald Trump. I mean, what just preceded Donald Trump was the Tea Party wave that did have that kind of rebellious, the establishment's not working for us mentality, and they tried to tackle the party and just couldn't do it. The numbers weren't quite there. Donald Trump saw the opportunity to kind of change it. Honestly, it wasn't Tea Party, because Donald Trump, if anything, the angry populism conflicted a bit with the Tea Party libertarianism. But Donald Trump won the day. I don't disagree with Charles on the word hijack, but I sometimes say he didn't hijack the party. He walked through the front doors to the open arms of the Republican Party looking for a change, and he found it. What do the traditional Republicans do with more traditional free trade, fiscal discipline, and so forth when debts and deficits actually mattered? And look, that number is still about 25% of the party, give or take. And so you're seeing a lot of them make a decision, do they stay or do they go? And there's a healthy number that are still determined to stay, thinking maybe the fever breaks. I think there's more permanence to it. What I think is fascinating is we're not covering as much what's the state of the Democratic Party that just 4 years ago was deciding between Elizabeth Warren and Bernie Sanders and AOC. And then in a flash, Joe Biden comes on the scene and builds the Soul of America coalition, and progressives are okay with that because they want to win. And it's not that he quieted the progressives. He just realized the coalition to win is going to take all of us. And now you're seeing that coalition move to include soft Republicans. It does not feel like there's a permanence to the Democratic coalition yet, but time proves out that permanence. So leading disaffected Republicans just last week, coming off the Harris event in Pennsylvania, were making the case to join the Democratic Party as kind of a centrist bloc. I don't know that we would see that happen, to be honest. That would be a true disruptor. But even then, you're not talking 55 or 56% coalition. You're talking 51, 52. The real issue here is the entire American electoral system is in need of structural reform. We're the outlier in the West of only having a two major party system and not having a multi-party democracy. It would cost $100 million to disrupt that and actually get recognized parties, minor parties in all 50 states that can become true coalitions with one of the two major parties, swing coalition parties. That is different than chasing an independent candidacy like No Labels tried to do this past year. That's just burning money. But shy of somebody investing in structural reform in the US, we're with this two-party system where the two parties will always be minority parties. And every 2 or 4 years, we see them try to cobble together a coalition. Sometimes there's permanence, like we're seeing a decade or more of the Trump coalition now. Sometimes it feels temporary, like we're seeing in the Democratic coalition right now. And we just have to see the direction it goes.
That doesn't bode well for long-term security and vision and planning.
Listen, I will tell you that the metrics in multi-party democracy show greater voter participation, greater voter satisfaction, greater voter approval of policy making. Every metric in multi-party democracies actually is greater than the metrics we have in the United States. We've just built one that is so entrenched. It's the system we have.
Well, let me turn to you and ask about the Democrats, Charles. So, one of the observations made, even before the campaign got going about President Biden was that, he did so well when he was lunch pail Joe, but not quite as well when he was Ray-Ban wearing Joe. But in a way, that kind of symbolizes some evolution in the Democratic Party where, you have seen this rotation towards more educated, affluent voters from a more traditional kind of blue collar union worker. Like we thought about, the Reagan Democrats that were so important in the 80s. Now you're looking at, a big, you're targeting college educated women. I mean, how do you think about the evolution of both the Democratic Party looking ahead, as well as its economic policies?
So I'd say a couple of things. One, I just take a small exception with the characterization of the Democratic Party as a minority party, as one of two minority parties. The last time a Republican has won the popular vote, it was 20 years ago in our presidential election. The Democrats, because of our electoral college system, it tends to our elections go back and forth, but the majority of Americans are actually on side with the Democratic Party, and I would argue on the key issues that affect this country and the world, but especially this country. A majority of to put it a slightly different way, I think the Republican Party is actually on the wrong side of where a majority of Americans are on everything from climate change, gun safety, immigration, a woman's right to choose, and marriage equality, just to get started. So, I don't think we're going to see a huge amount of reform in the Democratic Party. The Democratic Party feels pretty good about where it is. If Harris wins, it'll be sort of validation that the party's strategy of running in the center without losing the progressive base has been the right strategy. So we'll see. We'll know in 12 days. If Harris loses, what worries me about the party is typically when a party loses big, and this time, because they will have lost to Trump a second time after 2016, they beat him in 2020, but if they lose a second time this time, there's a risk that the progressive wing of the party will say, I told you so, you shouldn't have run in the center. And parties tend to retreat to their ideological corners when they lose, to kind of, lick their wounds and try to figure out how to regroup. For the Democratic Party, that would be a catastrophe. It means that they would retreat to their sort of, the more left or progressive corner, which then they would be a minority party and continue to lose. The only time a Democrat ever wins the White House is when they run in the center without losing their progressive base, right? Going all the way back to Bill Clinton, Barack Obama, Joe Biden, and now if Harris wins, Harris. I think on Biden, on your comment on, Lunch Pail Joe versus Ray-Ban Joe, the real reason that Joe Biden got pushed out of the race, primarily by Nancy Pelosi and the donors, was because his cognitive and physical decline had become so bad that he couldn't hide it anymore. For some of our clients who are in this room, as you guys know, I've been telling you for a year and a half that his cognitive and physical decline was much worse in person, and then the world saw it at the debate. I think that had more to do with him exiting or being forced out of the race than had he changed a lot, ideologically or in other ways in office. I think the truth is, the man's got literally advanced Alzheimer's and shouldn't be running the country. So I think that, that was
I was thinking more in terms of the broad arc of, he was a senator in the 80s. I think the broad arc of the party from one that was sort of, blue collar and now is basically has really claimed the educated elites. Not elites is probably the wrong word, but, if you think about, the voters have shifted from Republican to Democrat, have tended to be suburban, well-educated.
Yeah. No, I think that's a very valid point. I agree with that. The political divide in the country today actually is first and foremost along education lines. Literally, university degree or not is one of the biggest separations between Democrat and Republican. It's very, very interesting. And then Trump, who's been on the scene now for 8 years, is running and has been running as a populist. Populism, whether it's on the left or right, is incredibly intoxicating. It's incredibly attractive, especially when you tapped in, as Trump did, to the tens of millions of Americans in rural America, amongst other places, that have been increasingly left behind or falling behind. At the end of the day, I always say President Trump has the best political instincts in the country. That's why, again, I'm not discounting the fact that he might win and he's a very formidable opponent. He has the best political instincts in the country. This is a fourth time bankrupted reality TV star with really bad hair who made it to the pinnacle of world power. This is, a very serious candidate with great instincts. What he did in 2016 was tap into the tens of millions of Americans who have been left behind by saying to them, the American dream is dead for you and your children. And he had a message, and it was really simple. It was because of free trade, immigration, and China. Absolutely brilliant, very easy to understand. None of it was true. Almost none of it was true. The reason tens of millions of Americans, and this is happening in other countries in the world, that's why we got Brexit, for example, have been left behind, is mainly because of global monetary policy and automation. Immigration is another issue as well, but the truth is Trump had a message, and the Democrats didn't. So I think this election, coming back to your question, is really critical, not only meaning who wins, not only in terms of the future of each party, but also for the country. And of course, every election, the future of the country matters. This one, it matters even more. Which direction are we going to go in? Trump advances populism and some pretty unorthodox economic and other policies, or will the Democratic Party stay in the center, still be the party of business, innovation, and continue to move forward, and really believe in free trade and working with multilaterals abroad to defend our allies? We'll see. And lastly, sorry to take up so much time. I think if Trump loses, my Republican friends disagree. I think the party moves to purge him so quickly. I think they will literally throw him under the bus for two reasons. If he loses in 12 days, it'll be a 4-election losing streak. The midterms in 2018, the White House in 2020, the midterms in 2022, and now. Secondly, and by the way, there's no party in the world that would keep as party leader someone with that kind of losing streak, except maybe Labor under Neil Kinnock. But no one, no party in modern history would keep him. The other issue is if Trump loses, all of his legal issues accelerate. Donald Trump will be on trial 3 days a week, every week for 2 years on camera. You cannot have your party leader on trial for 2 years while you're trying to run in the midterms. The Republican Party will purge him so quickly. And all these Republicans that are literally, these electeds that are absolutely suffering from Stockholm syndrome, literally in love with their abuser, will also throw him under the bus. I'm here to tell you. So I actually am optimistic about the future of the Republican Party if Trump loses, because I think the party moves back to the center.
Mark, how are we doing on time? All right. I want to thank the panelists. Thank you very much. This was entertaining and informative.
Thank you.
12 days.
Thank you, Charles.
Yeah.
Okay, thank you very much. We just have 5 minutes to prepare for the next panel where we will welcome Commissioner Gentiloni. Thank you. Ah, il est là, vous n'avez pas vu. Then I'm gonna. Thank you very much. Thank you. Welcome. Please stay for the next session. Great.
Very nice panel. Gentiloni, the European Commission.
Ah, good. Good luck.
Yeah, he liked your panel, so.
Oh, good. Please. Hello, Stephanie. Please. Yes. Okay, everyone, please, if you can take your seat in order to start our next session. Welcome to the session. It will be, in fact, a conversation with Commissioner Paolo Gentiloni that will be shared by Renaud Debouk from UBS. Welcome, everyone, again. It's been some great panels this morning, and we will continue to do so during the day. Renaud, over to you. And Commissioner, thank you very much for joining us again. We met last year in Marrakesh. Again, thank you.
Hi, hello, everyone. Commissioner said he very much liked the previous panel, so maybe we'll get some discussion on politics. I have a couple of questions prepared, but then, yeah, we will very much appreciate also questions from the audience. But maybe it's been very topical at these IMF meetings, given that we had a cut also from ECB in October. There's a lot of elections in 2 weeks, implications for Europe. So maybe my first question would be is how do you assess the outlook currently of the EU from an economic point of view? It works.
Oh, okay. Well, first of all, good morning. Well, the outlook, it depends on if we look back to where we were, to the crisis that challenged our economy. I think that the outlook is not bad. As you know, the inflation is strongly and quickly declining in Europe. We had in the last figures in September, we had 1.7% of inflation. And interestingly, we should remember that 2 years before we had a double-digit inflation in Europe. So we'll see in the coming months, this curve could shortly, for a brief period, stabilize probably, but we are confident, and the European Central Bank is also confident that next year we will be below the 2% target for inflation. Labor market is very strong also. What is matter of concern, and this was also in the IMF outlook, is the level of growth for Europe. What the IMF outlook published is exactly the same of our spring forecast, which means a very moderate growth for the euro area, 0.8%, with a better outlook for next year. If we look to the level of crisis, if we look to the energy challenges that we had, I think that having avoided recession, I remember very well a couple of years ago, the situation was an incredibly strong rebound and level of growth after the pandemic. The EU economy was growing faster than America and faster than China, which was rather unusual. And this was 2022, 3.2 of growth in the EU. Then what happened? You know what happened in 2022, the war, and the consequences of this, of the Ukrainian invaded by Russia, are not always clear for our American friends, because for Europe, of course, it was not only a geopolitical threat, a threat to security, a geopolitical issue. It was a big economic fact. And the impact was huge. The decision to go out from dependence from Russian fossil fuels apparently was a very ambitious decision. So will the European economy be able to survive without cheap gas? What kind of problems we would have had? So after 2 years, I think we can say that the level of gas storage is the highest since many years. And these kind of risks were avoided. But the geopolitical uncertainty is still there, affecting our economies. And just to give you a simple example, what is happening is that inflation is going down, the level of wages is going up, purchasing power is at least partially catching up, but the level of consumption, especially in some large European economies, is not growing. What is growing is the level of savings. We have high level of savings. And this is the situation we are in. Within this situation, my last remark is that, of course, we, the European Commission, we are referring to average figures, but the situation are very different. The economy in Spain is not same that economy in Germany, just to mention two large European economies. And we know that in Germany we have definitely recession, and in Spain we have growth similar to the growth we have in US. So we refer to an average, but of course some countries are more affected than others because of this shift in the energy model and because of the difficulties in international trade and in manufacture. And this, of course, weight in the average level of growth of Europe. So I'm quite satisfied of the fact that we were able to go through this crisis without recession, without social consequences as dire as they could have been. Of course, we have social consequences, we have social difficulties, but I think we showed resilience. At the same time, the level of growth is too low, and we have to address it if we want to create jobs, reduce inequalities, and address the climate transition.
Yeah, maybe natural follow-up. You have the big four, Spain and Italy growing relatively well, France and Germany, people talk about downside risks to growth. And we had Axel Weber this morning, who was quite skeptical about any big reforms in Germany in the near term. He said a lot of the challenges will require 5 years, a new industrial agenda potentially. How do you look at spillovers within these big four economies. I mean, will this divergence hold or?
Well, we have differences. I think we could enter in details how tourism is impacting the Spanish economy, how concerning is the level of public debt in France, how the common funding was important for the Italian economy. Overall, I think this is my view that all Europe is challenged by the fact that a model that has been based on cheap gas from Russia, unlimited growth of trade with China, and security provided by US to make things simple. Well, this kind of model, the three pillars of this kind of model are challenged. And the level of the challenge is different, and the center of the challenge is in the journey, where trade is so important, where cheap gas from Russia was so important, but it is not a German challenge. It is a European one, despite the fact that levels of growth are very different among countries. And this is also to give to the European Commission the merits also that we had in the last 5 years. The differences are also partially based on the fact that we provided common money.
Yep.
And also weaker economies, weaker in terms of fiscal capacity, were able to use this common funding. And this is clearly also the case for Spain and partially for Italy. When we decided the common funding, what we call Next Generation EU, the motivation was, of course, solidarity, the pandemic, but it was also the awareness, for example, coming from Chancellor Merkel, the awareness of the risk of dividing too much the EU among countries with fiscal space and countries without fiscal space. So when we describe what happened in the last 5 years, I think we should remember that common funding was extremely important for countries with limited fiscal space. So, and broadly speaking, southern countries in Europe are performing not worse than northern countries, as it has been for maybe a couple of decades.
Yeah, I have to, I write a lot about the Italian debt, BTPs, and yeah, Italy is getting 1% of GDP from NGU till 2027 or something. And the key question for me is, what's the successor to this common funding?
Well, I think, well, first of all, of course, Italy had the bigger amount, was 209 billion euros grants and loans. But if we make the comparison in relation to GDP, there are several other countries, including Spain or Greece or Croatia or others, that received larger amount of money. I think, looking to my own country, that for sure, the fact giving this common funding for Next Generation EU had a tremendous impact in the reassurance of financial markets at the start of the story. Then it contributed in the last years also to a decent level of growth on EU average, more or less. But then now, in the next couple of years, there is the new challenge of putting these resources really on the ground, which, because of the nature of this tool, in our language, we call it performance-based, meaning we give money when some targets and milestones are achieved by countries, but then it is up to Italy and the other member states to provide the real expenditure of this money. And the level of real expenditure that several countries, including Italy, are asked for in the coming couple of years is enormous in relation to the normality. If this works, I think the overall growth of the euro area and the specific growth of countries like Italy, Spain, Portugal, partially also France, will improve strongly. If this is not happening, I think the risk of very low growth will continue to be there. So the challenge, overall, it was good. And I think we already can say that it was good. But it is not done because the mechanism is a complicated one. It's not like the IRA here in America. It is a mechanism requesting to European countries several efforts of reforms, not only investments. And if you ask to Spain or Belgium to have a pension reforms in relation to providing them common money, it is not easy at all, as you can imagine. And so this is the proof of the pudding, what will happen in the coming 2 years. And will we have a legacy of this common funding, or will it remain an episode connected to the pandemic?
Because Draghi in his report, he also has this idea to extend the borrowing in case there's no more investment. Is that something that?
I think it's, well, Draghi even goes beyond this because he also advocates, he is right, for the need for the European Union and Euro area to have a financial safe asset, permanent, which is, I think, absolutely understandable. We didn't propose it when we reformed our fiscal rules because the political atmosphere in the reform of the fiscal rule was already so tough and difficult that including also a permanent safe asset would have been really unrealistic. The proposal of the safe asset, which is building on a very simple fact that the European Commission is now issuing in financial markets something like 100 billion, 110 billion per year. And before this next generation EU, the annual issuance of the European Commission was few hundreds of millions. Now we have more than 100 billions. So what kind of continuity you give to this financial issuance? And this is the financial problem that Draghi is putting on the table. The other part of the message, I think, is easier to understand, not completely easy to implement. And it is where, in which sector a new proposal of using common funds could be accepted in the EU. I am not pessimistic about this. I know that there are, so to say, traditional cultural differences among countries and political families. When Mario's report was published, immediately someone said, no common funding. But at the end, I think this is the experience of the European Union, that when you open a door, it's difficult to close it. You create a president, and the president is there. My guess is that the more probable evolution of this kind of common financing tool could be defense. Why? Well, first, because defense is strongly needed in this time. And second, because there is a lot of dispersion of resources on defense, because each and every European country has its own expenditure on defense, multiplying overlappings and mostly spending outside the EU, by the way. 70% of our defense expenditure is buying military equipment outside the EU, not in the EU. And the third reason is that we have a higher level of consensus on the opportunity for common spending in defense than in other sectors. For example, part of the European countries, northern countries, Baltic countries that traditionally are reluctant in common spending are much more open if this common spending is related to common defense. So it will not be easy as always, but I'm rather optimistic on the fact that we will have follow-up of Next Generation EU. And one of the first sector where this follow-up could materialize is common defense.
Will you get a sovereign rating for the EU bonds?
Well, this is part of the conversation that I was mentioning before about the European safe asset. Of course, you all know that we are a very audacious and bizarre building. No? The European Union, we have since more than 20 years, a single currency, a central bank, a common monetary policy, but we don't have a Ministry of Finance, a common fiscal policy. These two streams, sooner or later, will converge or narrow their distance. By the way, this is what happened also in the US. The US maybe started with a federal treasury before having a federal bank. But now it's more than 20 years that we have a federal bank. And I think that gradually the two streams of monetary policy and fiscal policy inevitably will reduce their own distance. And the common funding is, of course, one of the tools to go in this direction.
We just need a German Hamilton. Maybe it's a good point to turn to questions from the audience.
The German finance minister, who is now the chancellor, referred to a Hamiltonian moment.
Yes, yeah, that's correct, yeah.
When the decision on Next Generation EU was taken. So maybe
should have stayed finance minister.
It could happen.
Maybe some questions from the audience. Over here. Sorry,
thank you very much for a fascinating explanation. Sir, when you were leading Italy, you established the Partnership with Africa for Green Transition and for Inclusive Social Development to stem the flow of migrants and make it more livable. I'm wondering, from the point of view of the European Commission now as regards the green transition in the global south and specifically Africa, given the challenges that we faced with the debt situation in the global south, whether there are any European initiatives to really revive or put a push on the climate change agenda and on achieving the green transition?
Well, I would say two things. First, on the climate transition itself, I think the European Commission and the President, who is the same of the previous Commission, will overall defend what we call the European Green Deal. Of course, the European Green Deal was very ambitious. It is politically controversial. It is not a Bible. We need flexibility in some targets, in some commitments. We just take a few weeks ago a decision to postpone one of the directive, which was about deforestation, for example, and I'm not excluding that further flexibility will be on the table. But overall, we are defending this commitment, and in view of the COP29, I think we will continue to push. We will have after lunch now a meeting of the G20 finance and climate ministers. This will also be an opportunity for the European Commission to confirm our commitment. But overall, this is not only about the climate transition. I think that Europe, and also the Commission, was in a certain sense forced to concentrate in a sort of horizontal dimension during the last years because of the Russian war in Ukraine. So, but if we look to the future of Europe, we have to restore the centrality of, so to say, a vertical dimension. So the relation between Europe, the Mediterranean, the Middle East, and Africa. This is where a huge part of the world population will live in the next 20, 30 years. This is where our historical relations are. And of course, we need to strengthen our security towards our eastern neighbors, but not forgetting to have our priority in relation with the Mediterranean and Africa. This, in theory, is in the plans of the Commission. Von der Leyen appointed a commissioner for the Mediterranean, which is something that is alluding to this. But then, of course, I'm not denying the fact that the pressure of the conflict in Ukraine is still very strong. But in my view, if we lose this, I call it vertical dimension, we are not looking to our midterm future. We are only looking to the challenge that we have in these very months. And this is, of course, a mistake for political decision making.
Good afternoon already, and thank you very much indeed. I'm Andrei from Romania. I worked a lot on European economic and monetary integration, and I have two questions. We are living nowadays in a period of very high speed changing world economy, world economic landscape. I'm talking here about the uprising voice of the global south, integration within the global south. And as far as I know, European integration is a peace promoting process. So why not EU should be involved more in negotiating, let's say, the landscape for a new world economic order, in which people do not invest anymore in military spending, but invest more in digitalization, incorporation of the technological progress, increasing the productivity, decreasing the financing costs. And my second question regards the competitiveness of the European Union, which was undermined over the past years and decades by the very weak level of growth of productivity, high level of the financing costs. If we look at equity risk premium in Germany, higher than in United States over the past decades by average annual pace of 2 percentage points, and of course, higher energy prices. There are many solutions already proposed by specialists. The problem is implementing these solutions, the speed of the implementation. If we look at the top 30 international competitiveness index, we are going to see that 11 countries are from the European Union. So we have positive examples that we can perform, let's say, on the global arena in a very good way. My second question regards the fact that at the end of the day, we need integrated energy markets, we need integrated capital markets. How can we increase the speed of implementing this EU energy market and EU capital market? And it's like a corollary because Mr. Draghi talked about a permanent facility. My master's thesis about Stability and Growth Pact written more than 20 years ago. According to Stability and Growth Pact, the countries should have budget balance in the mid-run in order to have maneuver room to intervene to up to 3% of GDP. Why not to create a permanent facility at the EU level of 3% of GDP, be used in an Italian Paretian way, 20% to counter the future crises that are going to happen, and 80% to accelerate and to improve the competitiveness of the EU. Thank you very much.
Do we take maybe one more question from the table? Then we'll do other tables. We'll go table by table.
Thank you. Thanks, Renat, and thanks, Commissioner, for being here. It's been really interesting. My name is Chris Crow. I'm from Capula. My question was sort of around trade and competitiveness in Europe. It feels like Europe sort of faces threats or challenges from both sides, right? On the one hand, an increasingly competitive China threatening, putting intense competitive pressure on Europe in its home markets and also in third markets. And at the same time, the US may be faced with similar competitiveness pressures, possibly moving in a much more protectionist kind of direction with tariffs. We'll see in a couple of weeks. Where does Europe sit on this question? Europe's traditionally been a supporter of openness and has benefited significantly from, global trade. Net exports have traditionally been a strong driver of European growth and with, relatively weak domestic demand. So does the EU still, hold to the principle of free trade and low tariffs, or is the situation changing now?
Yes, thank you. Well, indeed, the European project is a project of promoting peace. This is what we are talking about since almost 70 years now. And the way the European Union became a machine for peace has been also the fact that this project, born among 6 countries, is now involving 27 countries, with now 9 countries out of the door. Of course, all this creates decision-making difficulties, but yes, we have a union where 450 million people, this is enormously bigger than the starting point, are living under mostly the same currency, mostly no borders, common principles, freedom of movement for labor, goods, etc., etc. So something extremely important And it was a way out for non-democratic regimes, fascist in a part of our history, and then post-communist, and still now we have part of the Balkans and Ukraine, Moldova, and Georgia there. And this is an engine to enlarging this peace-building process. The fact that this is the nature of the EU doesn't mean that we can ignore the importance of common defense. I'm not saying that this means that defense expenditure needs to skyrocket. The problem is how defense expenditure is working in Europe, and it is working very, very badly. Buying outside Europe, and well, we always make the same example that we have 17 different type of tanks in the European Union, which is indeed quite crazy. But my view is that we should never believe that building a peace engine, an engine for peace, as the European Union has been and will continue to be, means ignoring defense needs. I hope we'll not have surprises from this point of view coming from the other side of the Atlantic, but in any case, we can't ignore this need. Well, for the rest, I'm not entering too much in the details of potential financial safe asset. We will see. It was interesting, your remarks, but this is not for a commissioner who is finishing his term in 40 days to enter in this kind of details. In general, I think the European Union should play an important role in the reform of the international financial architecture, which is the core business of the committee hosting us, and which is not an easy game because of all the implication on geopolitical implications that you know very well. But the pressure is there. So we discussed this morning in the G20, and I think the level of awareness of the need to make progress in this reform is there, with different opinions, of course, but I think progress are inevitable. And I have to recognize that some progress has been done, thanks also to the new, to the Biden administration, relaunching a multilateral approach on several issues, including climate change, global taxation, the use of special drawing rights. So I hope we will not miss this multilateral approach. Trade competitiveness, protectionism, openness. I can't imagine a European Union without openness in its DNA. I think this is what the European Union is. Trade for us is extremely important. The level of trade, for example, US-EU, only in goods and services is 1.6 trillion per year, so an enormous thing. Of course, we are aware of the need to adapt this openness to trade. And of course, we know that the solution that we found in terms of definition the famous de-risking and not decoupling is a good definition, but in search of content. Because what does this means in practical terms is something that we have to build in the coming months and years. Everything is evolving, also in the European Union. For example, our relation with China, were for sure too optimistic in terms of the possibility, the illusion of increasing trade and reaching a level playing field through the growth of the volumes and the level of trade. But the fact that we are now more cautious doesn't mean that we can close the door. So in other terms, a protectionist European Union is, in my view, impossible to imagine.
Yes. International Association, sorry. You mentioned the special drawing rights. And indeed, it was during the Italian chairmanship of the G20 that was decided this new SDR allocation equivalent to $650 billion. Now, the countries of the European Union do not really need for themselves those additional liquid assets. And there have been a number of schemes for reallocation of the special drawing rights of the EU member countries in support of various initiatives. In the context of our Robert Triffin Association, our Secretary General, Professor Fabio Mazzini of University Roma Tre, has put on the table a very ambitious program of EU-Africa cooperation, suggesting that if the EU countries were to pool together their SDR allocation, such a pooling could be used as a collateral for increased borrowings of the European Investment Bank and of the African Development Bank in support of a program with, which could be a multiple of those 150 or 200 billion SDR in support of investment priorities of Africa decided jointly and involving the African Union, which, as you know, is now also a member of the G20. I don't know if you have an opinion on this interesting proposal that comes also from Italy. Thank you.
No, I don't have a specific opinion, but I share your the spirit and your orientation. Despite the fact that I am completely aware of the legal national difficulties that we have, for some European countries, the very concept of SDR is difficult. There is a overall limitation coming from the European treaties on how you can use these resources for financing. But to have a more optimistic approach during my experience, which was not 30 years, it was only 5 years, things changed completely. I started my term as Commissioner for the Economy in the G7, where some crucial members of the G7 were in principle against the new emission of SDR. And one of the good results of the fact that Janet Yellen became Treasury Secretary was the fact that the American position changed. So now the discussion is how the reallocation is going. Is it sufficiently effective or fast? But 4 years ago, we had no SDR. I think we should go in the direction you were saying, knowing that these proposals are very difficult to implement for legal constraints that we have nationally at European level.
Thank you very much, Mr. Commissioner. My question would go back to the original issues of discussion, and in particular, the problems raised by the Draghi report, the latter report, and specifically the structural reforms that would be needed to restart innovation, productivity growth, and so on. We had a brilliant first panel here in the morning where the central bankers on the panel, current and former, stressed that the main problem now even for monetary policy is structural reforms, the European lack of growth, structural reforms, and the lack of fragmentation in the single market, particularly, and this is your area of expertise in the financial sector reform. So we have the reports, we have the blueprints, and then in reality, we are faced issues such as commercial bank resisting a takeover by an Italian leading a commercial bank. And so now you're going at sort of, in all honesty, how can this type of resistance really tackle, which is against the principles of single market, against the practice? Central European banks, half of them are still owned by EU-based cross-border banks, right? So it's not unprecedented. And this is what is in the way really of deepening the single market in an area where there is already European supervision for the big banks. So what is your take on this?
Well, I agree with the reports, both Mario Draghi and Enrico Letta. Of course, the risk for these reports to remain as wishful thinking is there. I'm rather confident of the fact that the president of the Commission is referring to the Draghi report very strongly. In the European Commission, we have these things that we call mission letter. So the president is telling you what you are supposed to do for the next 5 years. It doesn't happen because the events are probably changing what you are supposed to do. But this is at least theoretical roadmap, and the Draghi report is there for many, many commissioners. In theory, it is very clear we need stronger union of capital markets, we need scale if we want to finance innovation and to compete in terms of innovation. Because this cannot come from public funding, or at least not mostly from public funding, but you need stronger and more united financial markets. Then, when from this principle you go to practical proposals to overcome the national differences is, as you know, quite difficult. So I personally am not the only one in the room. Someone else with me assisted to several conversations among finance ministers. So when you look to the Draghi report, you agree we need this and that. When you try to build common supervision or to have common products or to change some rules, not easy. But let me give you a final remark. All what we were able to do in the last 5 years were not easy. It was not easy, the common funding. It was not easy, the reaction to Ukraine invasion. I was the Italian foreign minister after the annexation of Crimea, and the reaction at the time was completely different and very weak. The reaction now was very strong, despite differences that we have. It was unbelievable to cancel fossil fuels coming from Russia in a matter of months, and it happened. Of course, we know that decision-making in democracies is difficult, but my point is that this is not a European-only problem. If you look to for example, our common commitment to support Ukraine, is it easier in America than in Europe? I don't know. I think it is challenging both in America and in Europe. I heard something of the previous panel on the perspective of the coming elections. But then, apart from who will win, will the American democracy have a situation where the president and the Congress will have the same orientation? And if this doesn't happen, what kind of consequences we will have? I'm saying that we have to take note of the fact that democracy is a strong task. And if you work in Brussels, you learn how difficult, but also how important it is to forge consensus among different political parties, different nationalities. And this is how Europe works. But my point is that